The committee will come to order without objection. The chair is authorized to declare a recess of the committee at any time. This hearing is entitled The Dodd-Frank Act 5 Years Later. Are we more stable? Before proceeding, I wish to yield to the gentleman from Indiana for a very special introduction. The gentleman is recognized.
Thank you, Mr. Chairman. Unanticipated, but I would like to have everybody here get to stand up, Hudson. Meet my son, Hudson Messer, who is joining us today. It's his first time at a Financial Services Committee hearing. Thank you.
Welcome, Hudson. Take very careful notes. We're not always sure your father does.
He was watching the debt clock, though. Very impressed by that.
He'll have to pay for it. I now recognize myself for 3 minutes to give an opening statement. 5 years ago this month, Dodd-Frank was signed into law. Undoubtedly, it is the most sweeping, dramatic rewrite of banking and capital markets laws since the New Deal. Weighing in at 2,300 pages, 400 new rules. It is clearly dramatic. Whether fan or detractor, this committee would be negligent if we weren't vigilant in our oversight in both the impact and the implementation of Dodd-Frank. Negligent we will not be. So today marks the first of 3 hearings to be held on the Dodd-Frank bill, posing 3 different questions. 5 years after Dodd-Frank, are we more prosperous? 5 years after Dodd-Frank, are we more free? And the focus of today's hearing, 5 years after Dodd-Frank, are we more stable? I frankly believe it remains an open question whether we have achieved greater stability. I fear the answer is no. But were the answer to be yes, when you look at the damage Dodd-Frank has done to our economic growth, to family finances, and consumer freedom, I am rather doubtful it would be worth the cost. Clearly, balance sheets have improved post-Dodd-Frank, and banks have delevered. This is a necessary and good thing, and I strongly suspect that market forces would have brought about these actions regardless of Dodd-Frank. Regulators already possess the powers to have set more prudent and capital and leverage standards. Still, Dodd-Frank very well may have been helpful in this regard. But what is undebatable is the fact that since the passage of Dodd-Frank, the big banks are now bigger. The small banks are now fewer. In other words, even more banking assets are now concentrated in the so-called too-big-to-fail firms. Pray tell, how does this improve financial stability? Dodd-Frank has codified too big to fail into law and provided a taxpayer-funded bailout system in Titles I and Titles II of the Act. This simply leads to even greater moral hazard and to greater instability. According to the Richmond Federal Reserve, the explicit federal guarantees of financial sector liabilities have increased to a whopping 60% post-Dodd-Frank. When private investors and depositors and counterparties expect a bailout, their incentives to monitor risk clearly wane. Regulatory micromanagement is no substitute for market discipline. By this measure, Dodd-Frank has clearly made our financial system riskier. Part of the expansion of federal backstop has been the creation of a whole new class of too-big-to-fail institutions, namely centralized clearinghouses for derivatives. Here, Dodd-Frank didn't lessen risk, it just centralized it and placed it on the taxpayer balance sheet. Next, Dodd-Frank's Volcker Rule, along with the Basel Accords, has caused a massive drop in corporate bond inventories. Many economists now believe the next financial crisis could very well result from the illiquidity and volatility in our bond market. Senator Dodd of Dodd-Frank said, quote, "No one will know until this is actually in place how it works." 5 years later, we have a clue, and we are learning that our financial system may very well be less stable under Dodd-Frank. Now I'll yield 5 minutes to the ranking member for an opening statement.
Thank you, Mr. Chairman. Today's hearing is the first of 2 scheduled in recognition of the 5th anniversary of the Dodd-Frank Wall Street Reform Act. It's important to remember that the 2008 financial crisis was not a natural disaster. Instead, it was a result of deliberate choices, choices on the part of some of Wall Street who put their own short-term interest ahead of the long-term economic health of our nation's investors and consumers. It's the result of choices on the part of some of our regulators who failed to respond as both vulnerabilities and illegalities in our financial system emerged. These choices had tremendously damaging consequences. Our nation became plagued by small business closures, large drops in the stock market, stunning job losses, rising foreclosures, and fears of a looming repeat of the Great Depression. In the 6 months before President Obama took office, our economy hemorrhaged nearly 4 million private sector jobs, an average of 650,000 per month. Nearly $16 trillion in household wealth simply disappeared. The retirement accounts of many hardworking Americans were swept away. Around 9 million individuals were displaced from their homes, many of whom may never again have the opportunity for home ownership. Once the economy was stabilized, Democrats worked diligently on legislation to restore responsibility and accountability to our financial system and instill confidence that we had the tools in place to protect Americans from another crisis. Since Dodd-Frank was enacted 5 years ago, the American economy has added nearly 13 million private sector jobs, and unemployment has fallen by 4.7 percentage points, its lowest level since September 2008. The housing market is recovering, with home prices rising, negative equity falling, and measures of mortgage distress improving. Retirees' investments are recovering as well. The S&P 500 has risen more than 250% since February 2009, and average 401k balances reached a record high in 2014. But even as we celebrate our success at avoiding a second Great Depression, it's important to recognize that the events of 2008 have cast a long shadow over our nation's growth and prosperity, one which has not been shared equally by all. Research from Cornell University found that the foreclosure crisis has resulted in an increasing level of resegregation in many urban areas. Several institutions confirm the foreclosure crisis likely had substantial negative impacts on child well-being, with multiple moves and marital discord leading to anxiety, depression, and poor performance in school. The crisis also exacerbated what was already an unacceptably large wealth gap between white and minority households. The Pew Research Center found that the current wealth gap between African Americans and white has reached its highest point since 1989. The current white to Hispanic wealth ratio has reached a level not seen since 2001. We must go further to address these lingering challenges. But make no mistake, we've made progress. Most notably, in Dodd-Frank, we created a Consumer Financial Protection Bureau that in just a few years has already returned $5.3 billion to 15 million consumers who have been subjected to unfair and deceptive practices. We have worked with the Bureau to create rules of the road to make sure predatory mortgages never again strip wealth from American families and endanger our economy. And we worked regulators to institute rules to protect retirees and other investors from the practices that wreaked havoc on savers in 2008. But, Mr. Chairman, too much time has been wasted in Congress by a majority bent on austerity policies that leave workers, retirees, and minority communities behind, while ignoring the substantial progress we have made toward deficit reduction. Too much energy has been spent trying to relitigate the causes of the 2008 crisis, which at this point everyone should recognize as settled. Finally, far too much effort has been spent by the Republicans to weaken our regulatory apparatus, whether through underfunding our regulators, relentlessly pursuing or pressuring them to go soft on rules, or injecting unrelated Wall Street giveaways into must-pass government funding bills. I'm tired the Republicans' death by 1,000 cuts strategy to roll back the significant gains we've made since Dodd-Frank enactment. 5 years later, I urge my colleagues to take stock of where we were and how far we've come, and I suggest they recognize that much like the recent Supreme Court decisions to uphold Affordable Care Act and disparate impact standard to prevent discrimination in housing, Dodd-Frank is settled law. Thank you, and I yield back the balance of my time.
Chair now recognizes the gentleman from Wisconsin, Mr. Duffy, Chairman of our Oversight and Investigation Subcommittee, for 2 minutes.
Thank you, Mr. Chairman. When Dodd-Frank was enacted 5 years ago this month, Senator Elizabeth Warren and President Obama promised Americans that this law would lift the economy, that their hard-earned money would be safer, that markets would be more stable, and that no one institution would threaten the safety and soundness of the global financial system. As we've seen this law implemented, it has left much to be desired. In large part, the 2008 financial crisis was a result of federal financial regulators failing to do their job and their inability to anticipate the looming issues in the subprime mortgage market. Dodd-Frank rewarded incompetency with more responsibility. The law has created new areas of risk concentration, enshrined too-big-to-fail institutions, made it more difficult for small banks to compete, and done damage to the economy that is still too difficult to quantify. The law of unintended consequences has never been more apparent than when we look at Dodd-Frank. The pursuit of financial stability has come at a cost. While the goal may be worthy, we must look at the collateral damage along the way and ask ourselves if we're going down the right path. Compliance burdens are crushing small institutions, and though banks may be better capitalized, we are now seeing negative market impacts stemming from these new regulations. The FSOC and Treasury Secretary Liu don't really want to admit that Dodd-Frank may be at the center of illiquidity that we're seeing in the bond market. With banks having to hold on to more capital and pulling out of market-making activities, these markets are left withering in the wake of Dodd-Frank and other international regulations. Another product of Dodd-Frank is the Consumer Financial Protection Bureau, the CFPB, which was tasked with protecting consumers of financial products and services from discrimination. Ironically, it has the worst track record of all federal financial agencies of EEO complaints, proving the agency is inept at best or negligent at worst at protecting its own employees from discrimination and retaliation. Further, sources of small dollar credit products that millions of Americans rely upon are now in the crosshairs of the Bureau. The government knows best mentality, the nanny state mentality, has gone too far. Americans are capable of choosing products and making decisions that they know are in their best financial interests. The CFPB is eliminating consumer freedom and imposing political agendas that I just don't think work, Mr. Chairman. This is the Gruber mentality, along with, well, I'll go there later. I'll yield back.
Notwithstanding the fact the gentleman was on a roll, the time of the gentleman has expired. Today we welcome the testimony of our distinguished panel. I will introduce them at this time. First, Mr. Paul Atkins, CEO of Potomac Global Partners. He is a former commissioner of the Securities and Exchange Commission appointed by President George W. Bush. I also note a fellow member of the TARP Oversight Panel. Before his appointment to the Securities and Exchange Commission, he served on the staff of 2 SEC chairmen, worked as an attorney in private practice, graduate of Vanderbilt University School of Law and Wofford College. Dr. Mark Calabria, Director of Financial Regulation Studies at the Cato Institute. Before serving at Cato, he served as on the staff of the Senate Banking Committee and Deputy Assistant Secretary for Regulatory Affairs, the Department of Housing and Urban Development. He holds a doctorate in economics from George Mason University. Mr. Damon Silvers is Director of Policy and Special Counsel at the AFL-CIO, where he has advised on a range of financial services matters before the Treasury Department, the SEOC, and the PCAOB. I also note he served as the Deputy Chair of the Congressional Oversight Panel, another fellow alum. I think we're maybe too shy of a full reunion at this time. We might leave it that way. Professor Todd Zawicki is a Foundation Professor of Law and Executive Director of the Law and Economics Center at George Mason University. He was previously an attorney in private practice, a law clerk for Judge Jerry Smith, the U.S. Court of Appeals for the Fifth Circuit, a graduate of the University of Virginia Law School, Clemson University, and Dartmouth College. Each one of you gentlemen I know has testified before our committee, so I trust you need not have a remedial tutorial on our lighting system of red, yellow, and green. Each of you will be recognized for 5 minutes to give an oral presentation of your testimony, and without objection, each of your written statements will be made a part of the record. Mr. Atkins, you are now recognized for 5 minutes to summarize your testimony.
Thank you, Mr. Chairman. Good morning, Mr. Chairman, Ranking Member Waters, and members of the committee, and thank you very much for inviting me to appear at your hearing today. Given my background, I'm going to focus my remarks on the impact of Dodd-Frank on the U.S. capital markets. I think the single largest problem of the Act is Title I, entitled Financial Stability. The conceit of authors of Dodd-Frank is that if you get enough smart people in a room with enough data, they can bring stability to the marketplace. But just as human beings cannot be counted on to be predictable and stable, those of us who have spent a lifetime engaged with the capital markets know that they also are not always stable, because human beings, with all their foibles, make up markets. Ultimately, though, the freedom of individuals to make their own decisions is not a curse, but a benefit. A little over a year ago, I testified before this committee on the FSOC's embarking on a misguided effort to apply bank prudential regulation to the capital markets by designating asset managers as systemically important financial institutions, or SIFIs. After much pushback, including by many of you on this committee from both sides of the aisle, both the FSOC and the International Organization of Securities Commissions now indicate that they are moving away from designating asset managers as SIFIs. But that decision is not carved in stone. Take the Financial Stability Board, which seems not to have changed its course to designate funds and asset managers as global SIFIs, even though the only funds and managers that meet their materiality threshold are American. That raises serious competitive implications for the U.S., just as the European Union embarks on an initiative to encourage pan-European capital markets. In short, the story of the attempted prudentialization of capital markets is not going away. I fear that the U.S. capital markets, which have been the driver of economic growth and job creation in this country for decades, will be the collateral damage in the elusive quest for, as I say, stability über alles. Another Dodd-Frank provision that's emblematic of a flawed legislative process is the Volcker Rule. Despite not being included in either the House or the Senate bill, and without any substantive hearing to consider the specific language of the rule, the potential effects or unintended consequences of the provision, the Volcker Rule became law. Basically, the Volcker Rule is aimed at banning proprietary trading in commercial banks. Because it's easier to blame Wall Street and excessive risk-taking for the financial crisis than the federal government's own housing policies, many have trumpeted the Volcker Rule as the best reform of Dodd-Frank. But even former Chairman Volcker himself has acknowledged that, quote, proprietary trading in commercial banks was not central to the crisis. Yet the statute and implementing regulations turn regulators into amateur psychologists. They might as well have a Ouija board to determine intent under the rule. Rather than risking running afoul with regulations, banks have reduced their market-making activities. Combining the Volcker Rule with higher capital requirements at home and abroad has literally sucked essential working capital out of the market-making activities of banks. Banks no longer act at much as principals in trading anymore, but as agents. That decreases market liquidity on a daily basis. Even though Secretary Lew, who, by the way, does not have a financial background, refuses to acknowledge it, the Volcker Rule is a needless regulation that has caused and will continue to cause harm to issuers and investors. As the chairman quoted at the outset, former Senator Dodd famously said, quote, no one will know until this is actually in place how it works. 5 years later, the full effects of Dodd-Frank are still unknown, but the costs certainly have been borne not just by Wall Street, but by ordinary investors and businesses of all shapes and sizes who are no safer today than they were in 2008. Indeed, small investors will suffer more pain if the administration goes through with the proposed changes to the ambit of fiduciary duty under ERISA, to say nothing of the myriad special interest provisions in Dodd-Frank that had absolutely nothing to do with the financial crisis, such as conflict minerals certification, mineral extraction disclosure, and the CEO pay disclosure. Moreover, until Congress reclaims some of the authority that it gave regulators under Dodd-Frank, particularly the authority given the FSOC and the Federal Reserve under Titles I and II, the greatest risk to the U.S. capital markets remains that government, and not the markets, will ultimately choose winners and losers. Thank you, Mr. Chairman.
Thank you. Dr. Calabria, you're now recognized for your testimony.
Chairman Hensarling, Ranking Member Waters, and distinguished members of the committee, thank you for the invitation to appear at today's important hearing. I will note it's been almost a year since I appeared before the committee, so I was starting to wonder if I had worn out my welcome. So it is a delight to be back and, of course, an honor to be part of such a distinguished panel. The subtitle of today's hearing raises what I believe is probably the single most important question in financial regulation: are we more stable? Let me cut the suspense and give you my answer. I think it's no. Now, let me tell you why. And I will note there have been improvements, and I don't think anybody would disagree with that. I talk about in my testimony the improvements we've seen in bank capital, but my own opinion is that the net improvements have been outweighed by the net downsides. This is also an extremely broad topic, so I touch on a number of things in my written testimony, which I will be delighted to discuss later, but I'm only going to focus on a few right now. Let me first focus on what I believe one of the more important contributors to financial instability is, which is the moral hazard created by both explicit and implicit guarantees of risk-taking. The Chairman mentioned the Richmond Fed's bailout barometer. As he noted, this is up to a full 60% of our financial system liabilities, either explicitly or implicitly backed by the Federal Government. I will note this is higher than both before Dodd-Frank and before the crisis. Part of the measure of the implied too big to fail is the too big to fail subsidy of our largest banks. For reasons I detail in my written remarks, I do not believe that Dodd-Frank has ended too big to fail. I will note that according to recent polling, neither does a plurality of the American public believe that either. Some would claim that Title II's orderly liquidation process ends bailouts. I will note that I worked on a similar mechanism created under the Housing Economic Recovery Act for Fannie Mae and Freddie Mac. And so let us not forget, we had the tools to resolve Fannie and Freddie without a dime of cost to the taxpayer. Those were on the books. Those were not used. So maybe I'll characterize my concern this way. The ranking member mentioned choices. We are faced with that next time. Regulators will have the choice whether they resolve an institution without relaying to the taxpayer, without taxing the rest of the financial services industry, or whether they impose losses on creditors. So let me emphasize, while I agree that Dodd-Frank's Title II offers a path to imposing losses on shareholders and creditors, I could not overemphasize it is a choice. One of the reasons I believe that choice will not be taken is if you simply compare an institution like Freddie Mac, which is smaller and less complex than an institution like Citibank, it suggests to me that it's very hard to believe that we would actually let Citibank fail. There are a number of other institutions that we may let fail, but I don't think some of them would work. I appreciate and commend the FDIC's attempts with its single point of entry to try to improve upon that process. Setting aside its questionable legality, I would also emphasize it's an optional approach. Whether it is actually followed or not is an open question. Were it credible, markets would price holding company debt and subsidiary debt differently. Recent research from the New York Federal Reserve shows that this is not happening. So apparently the markets don't even believe the single point of entry is going to be effective. I will note that a handful of studies have found that designating systemic entities as systemically important, as is done under Title I, leads market participants to view these entities as too big to fail. I'll remind the committee in this very room in 1984, when the control of the currency told us the 11 biggest institutions were too big to fail and they were going to be heavily regulated, we still ended up bailing out some of those institutions. So it is bad enough that unfortunately the implied guarantees of our largest banks have been further backed. We also have extended that privilege, as the Chairman noted, to financial market infrastructure such as clearinghouses. Another important driver of instability is monetary policy. Years of negative real interest rates incentivize all sorts of reckless behavior. Such helped inflate the housing bubble. I am certain that we are currently massively distorting our financial markets with our current monetary policy. Let me be very clear in my opinion that the Fed's current policies will be very painful when they unwind. Most of us agree that mortgages played an important role in the crisis. Dodd-Frank has indeed attempted to address problems in the mortgage market. As I detail in my testimony, I believe these attempts have fallen short and in many instances done more harm than good. I believe the evidence is overwhelming coming from such neutral parties as GAO that loan-to-value and borrower credit are the main primary drivers of default, yet these have been ignored. I remind the committee that Congressman Frank sat at this table last year and testified that he clearly meant that down payments should be a part of QM and QRM. The regulators have gutted these provisions, making them worse than useless. Perhaps worst of all is that Dodd-Frank has driven almost all the mortgage risk in the United States on the backs of the taxpayer. Fannie, Freddie, and FHA all hold essentially zero capital. When the housing market turns, which it will, the taxpayer will face a very large bill. Even the IMF, no lover of free markets, highlighted earlier this week the instability risks from our housing finance system. If we continue along this path, I estimate that at least 1 million families will lose their home in the next downturn from the reckless underwriting practices of FHA alone. Mr. Chairman, I commend you for calling today's important hearing. As we painfully learned over the last decade, financial crises are extremely costly and painful both for our economy and for American families. Had Dodd-Frank brought more stability to our financial system, I would be the first to applaud it. I do believe it has not. Without sufficient reform, I believe we are almost certain to see another painful crisis within the next decade. Sadly, the warning signs were ignored before the last crisis. I urge Congress not to ignore these warning signs this time around.
Thank you, Mr. Silvers. You're now recognized for your testimony.
Good morning, Mr. Chairman, Ranking Member Waters, members of the committee. My testimony today is given both on behalf of the AFL-CIO and of Americans for Financial Reform, a coalition of over 200 organizations. The Dodd-Frank Act passed in the wake of a financial crisis that cost the United States $22 trillion, according to the GAO. In the course of that crisis, 10 million families were thrown out of their homes and tens of millions lost their jobs. That's what the statute was seeking to prevent occurring again. But the Dodd-Frank Act was a compromise. It did not place size limits on financial institutions, it did not restore the Glass-Steagall Act, and it did not fundamentally change the incentives in the executive compensation system of our financial firms to take on excessive risk. Rather than making these fundamental structural changes, the Act gave regulators the possibility of making structural change. This goes back to Dr. Calabria's point about choices. What Dodd-Frank did do was resurrect fundamental principles of financial regulation that had been forgotten in the race to deregulate in the 1980s and 1990s. Most of all, the Dodd-Frank Act created a clear, workable alternative to the bailout of systemically significant institutions. The resolution process contemplated in Title II that places the responsibility for first-dollar losses in distressed situations clearly where it should be, on the too-big-to-fail firms, their equity holders, bondholders, and executives. However, I would associate myself with Dr. Calabria's comments that this requires regulators to actually choose to use it. The U.S. financial regulatory system prior to the Dodd-Frank Act was a Swiss cheese system, full of holes allowing financial actors to evade both capital and transparency requirements for the price of a lawyer. The Act closed many, but not all of these loopholes. 5 years later, among the clear results of these changes are a reduction in the credit market's perception that the government will bail out the nation's largest banks if they get into trouble. GAO found that while there was a very large subsidy in the credit markets for too-big-to-fail banks in 2009 and 2010, between 2010 and 2014, that subsidy fell to near zero, as regulators showed through the progress of living wills, the adoption of single point of entry, and the refinement of stress tests, that they were serious about enforcing the provisions of Title II. But the Dodd-Frank Act was not simply about protecting the financial system from itself. Its explicit purpose was to make financial markets less of a rigged game from the perspective of consumers and investors. Here, the track record is impressive and expanding. For example, the CFPB has returned $5.38 billion of improperly obtained fees and penalties to over 15 million consumers and their families. And the Securities and Exchange Commission recently has begun using the Act to uncover widespread abuses of investors by private equity and hedge fund managers. However, the Act necessarily depends on regulators to implement and enforce it. And all too often, over the last 5 years, regulators have succumbed to political pressures not to, particularly in the area of executive compensation. And then there is the recurring impulse in Congress to weaken financial regulation, that same impulse that brought us the crisis in the first place. We saw this on display in the Cromnibus negotiations last winter, where Congress worked with the Obama administration to repeal the hard-fought derivatives push-out provisions and once again relink the derivatives market to the deposits of American families. Efforts to weaken the Dodd-Frank Act have involved the use of a series of spurious arguments, including, quote, cost-benefit analyses that looked only at the costs and not at the benefits. These sorts of arguments only have weight because of the political and economic power of the people making them. And this brings us back to the issue of too-big-to-fail banks. The truth is that because the Dodd-Frank Act was a compromise, because it largely left to the regulators the question of structural change, it has proven to be vulnerable to the continuing political power of the handful of too-big-to-fail banks that continue to dominate our financial system and exert a disproportionate influence on our politics. In this sense, the unfinished agenda of financial reform is inextricably intertwined with the ability of the regulatory system to effectively implement the Dodd-Frank Act as it is, to ensure the financial system does its job of efficiently transforming savings into investment, and to protect the U.S. economy and the American public from a costly repeat of the financial crisis that began in 2007. My answer, Mr. Chairman, to the question posed in the title of this hearing is that the Dodd-Frank Act has definitely helped make our financial system more stable, but unless we deal with the too-big-to-fail problem more directly, the Dodd-Frank Act itself is not stable. Thank you.
Thank you. Professor Zawicki, you're now recognized for your testimony.
Thank you, Mr. Chairman, Ranking Member Waters, and members of the committee. I'm a scholar of consumer credit and a former FTC senior staffer, and as a result, I was especially disappointed that Dodd-Frank has squandered an opportunity to modernize our consumer protection, financial consumer protection system to a regime that would promote competition, consumer choice, and innovation. If you look back at the record of the past 5 years, instead, Dodd-Frank has substituted the judgment of Washington bureaucrats for American families with respect to the financial products that will make their lives better, thrown a blanket of uniformity over consumer credit market, strangling innovation and crushing community banks, raised prices and reduced consumer choice with respect to financial services, and by reducing access to financial services, and because many small businesses use personal credit in their own businesses, has dampened economic growth and recovery. And I think most tragic of all, Dodd-Frank has done little to increase consumer protection for American families, but by driving millions of consumers out of the mainstream financial system and into the hands of payday lenders, check cashers, pawnbrokers, and all the other alternative financial providers, has actually made life worse for the most vulnerable members of society. At the heart of Dodd-Frank was the Consumer Financial Protection Bureau, which is both the most powerful and unaccountable bureaucracy in American history, with ability to regulate virtually every consumer credit product under vague and poorly defined standards. If we look at the track record of the CFPB and the way in which Dodd-Frank has been implemented, we see a sweeping amount of damage to American families as a result of this law. First, Dodd-Frank has destroyed free checking for millions of Americans. Prior to Dodd-Frank, 76% of Americans had access to free checking. Since Dodd-Frank is enacted, that number has fallen to 38%. Bank fees have doubled as a result of Dodd-Frank, driving approximately 1 million, if not more, consumers out of bank accounts and into the alternative financial sector. With respect to credit cards, by interfering with the ability of credit card issues to accurately price their risk, it's estimated that 275 million credit card accounts were closed, $1.7 trillion in credit lines were eliminated, and again, those who bore the brunt of this were the lowest income consumers. According to the Federal Reserve, the number of lowest quintile households with credit cards fell by 11 percentage points in the period since Dodd-Frank was enacted, taking credit cards out of the hands of American families and forcing them to turn to payday loans and other alternatives to try to pay the rent and to try to prevent eviction. With respect to mortgages, Dodd-Frank has raised, and the qualified mortgages rule has raised the cost and risk of lending, and continue to slow the housing recovery and access to mortgages. Yet by doing nothing about down payments or and many of the other factors that led to the financial crisis, Dodd-Frank is doing little to prevent the next financial crisis. Perhaps most notably, Dodd-Frank's rules, by throwing this blanket of uniformity and bureaucratic underwriting over the mortgage market, has driven community banks out of the mortgage market. According to a Mercatus study, for instance, 64% of community banks have changed their mortgage offerings as a result of Dodd-Frank and the CFPB, and by creating this new de facto plain vanilla rule, they have eliminated the ability of community banks to compete on what they do best, which is relationship lending. With respect to one other area I'd like to flag is this extraordinary data mining operation that the CFPB has undertaken with respect to consumer data. And perhaps this evidences best the dangers of creating a super unaccountable bureaucracy like the CFPB that and the sort of egregious behavior that this leads to. For those who are not familiar with this, it's estimated the CFPB is routinely scooping up 600 million credit card accounts, 22 million mortgages, 5.5 million student loans, all without the knowledge and consent of American consumers. And that's still not enough. They want 95% of credit card accounts. According to one estimate, this is 70,000% more data than the CFPB needs in order to effectuate its regulatory purposes. This is especially worrisome in light of the fact that the director of the CFPB himself has admitted that this data could be reverse engineered, and in light of recent data breaches at the IRS, OPM, and elsewhere. Thank you.
Thank you. The chair now yields himself 5 minutes for questions. Mr. Atkins, in your testimony on page 8, you posit one undisputed effect of the Volcker Rule has been a reduction in corporate bond inventories of primary dealers. Next time you posit that, I might suggest you offer the caveat, unless you're an economist employed by the Federal Reserve or the Financial Stability Oversight Council. They seem to be the only ones in the world who can't connect the Volcker Rule with this undisputed reduction. Even the Financial Stability Board, as you point out in your testimony, Governor Mark Carney of the Bank of England warned the Volcker Rule, quote, could reduce global financial resilience rather than increase it. So you cite in your testimony, I believe, a 77% drop in primary dealer inventories of corporate bonds since the crisis. So can you expound on your views of how this could create greater instability in our markets?
Well, thank you, Mr. Chairman. Well, basically, because of the regulatory apparatus and the uncertainty that the Volcker Rule has created with respect to banks operating as, with their own money in the marketplace as market makers, banks have tended to back away from doing any proprietary trading because they feel that that's only going to get them in trouble. And so because of that, that just means on a day-to-day basis that there is that much less of participation by the banks in the marketplace. So that creates a question with respect to liquidity and a decrease of that on a day-to-day basis.
On page 4 of your testimony, you speak of the potential for asset fund managers to be designated as systemically important financial institutions under the Dodd-Frank regime, and speak that you question what this could do to risk management or liquidity in the market. If that takes place and fund managers are found to be SIFIs, or in deference to you, sci-fis,
right.
Give me your views on how this impacts market stability.
Yeah. Well, the real fear is the extension of prudential bank-type regulation into the capital markets. And prudential regulation grew up by the banking regulators because that's their mission, is safety and soundness of the the banking system. Whereas on the capital markets side, we've created, the goose that lays the golden egg here in the United States, where innovation and competition really has made a very dynamic marketplace that truly is the envy of the world. Not too long ago, I was at a dinner with the head of a multilateral international lending operation, a government type of lending operation, and he told me he could not believe what the United States is doing to its capital markets, which he said, of course, with Asia and Europe, is truly the envy of the world. So that's really the ultimate worry, is that because of the Fed and the FSOC being able to have prudential regulatory authority over the capital markets, that there will be less activity there, and they'll ultimately be able to direct, either tell people not to trade or to acquire certain securities.
Dr. Calabria, you mentioned this in your testimony, and our Professor Zawicki spoke about our housing markets. On page 15 of your testimony, you mentioned Dodd-Frank could very well result in an increase in the level of mortgage defaults during the next housing bust. So we just have come off a rather painful housing bust. Could you expound on your views of how Dodd-Frank might just bring us full circle?
Sure, I would be happy to. And so let me set aside the issues that might reduce defaults and talk about some of those in the legislation that might increase defaults. A number of scholars have found that the longer you delay the foreclosure process, for instance, the more people that end up in delinquency. And of course, a number of provisions in Dodd-Frank extend the length of the foreclosure process. And of course, things like letting borrowers know that if you're in a non-recourse state, that they can walk away. If it will have any effect at all, will be to encourage those borrowers to walk away. So there are a number of provisions that, to me, will drag out the foreclosure process, resulting in larger foreclosures. I would hope that one of the lessons we would take away from the crisis, and for instance, if you compared judicial to non-judicial foreclosure states, is that when you make it very hard to foreclose, you get more foreclosures in terms of the reaction of borrowers.
In attempting to set precedent, I will not go over my time. The chair now yields 5 minutes to the ranking member.
Thank you very much, Mr. Chairman. Before I get to one of the main questions I would like to ask, I would like to ask, I think it is Mr. Atkins, do you agree that the Financial Protection Bureau has returned $5.3 billion to 15 million consumers who've been subjected to unfair and deceptive practices?
I don't know the exact number, but from the paper, I've seen that they're even having trouble identifying supposedly who has been harmed in some of those cases. So they collect money from their settlements where people feel over the barrel that they have to pay to get the regulator off their back. But the query is, who's being harmed and how do you show who's being harmed?
Mr. Silvers, as Deputy Chair of the Congressional Oversight Panel, created in order to oversee the Troubled Asset Relief Program, that is TARP, you had a front row seat to our government's response to the crisis, starting with the Bush administration, placing Fannie and Freddie into conservatorship, and continuing with then Treasury Secretary Hank Paulson injecting billions of dollars of capital into our nation's largest banks in order to forestall economic chaos. Can you take us back to that time? And again, you have done some of this in your testimony, but remind the committee just how bad the economy was during the depths of the crisis. Can you again remind us what was happening to American workers in terms of home foreclosures, small businesses, the closures, and 401k plans being decimated?
Member Waters, I'm happy to do that. It gives me a moment also to recall the time that I spent with the chairman in that work, and to reflect on a lot of the bipartisan things we did together, which I think is all too rare in our time. The story you asked me to tell is one that we don't have time for the full horror of, but just a few anecdotes. I remember then Deputy Treasury Secretary Bob Steele in the fall of 2007 saying to me, we're going to have a big problem. We might have as many as 1 million foreclosures. This is the number Dr. Calabria is worried about. Of course, by the time we were done, we had 10 million. That's 40 million people set out in the street. The median net worth in the course of that process of African American families fell from $18,000 to $6,000. It's never recovered. We had as many as 25 million Americans out of work. We had the economy contracting in the fall of 2009, according to Paul Volcker, at a rate greater than it was contracting during the depths of the Great Recession. We put several $100 billion into the nation's largest banks, being told at the time by the Treasury Department that they were all solvent. It is my belief that it has become quite clear that at least 2 of them, Citigroup and Bank of America, were certainly insolvent at the time that they were given the money. And it is unclear that if the money had not been given, if any of them were solvent. We provided the money on terms that were only 60 cents on the dollar to the American public. Later, Treasury Secretary Geithner asserted that we got our money back, but that statement assumed that the listener was extraordinarily naive. We propped the banks up and then we didn't get the upside. That's what those numbers meant. The upside went to the people who caused the problem in the first place. I think we need to recognize in looking through this history a couple of things. One of them is that had nothing been done, we would certainly have been in a prolonged situation like the Great Depression. And that the Bush, this will seem like a strange thing for me to say, but the Bush administration and Democratic Congress, and particularly Hank Paulson, deserve great credit for acting. But the failure then to restructure our banks, the failure to restructure home mortgage debt devastated our economy. And although my fellow witness, Mr. Atkins, feels that our capital markets are the envy of the world, and they may well be now, at that time they were widely seen as having initiated, as our capital markets were widely seen as having initiated a global financial crisis that cost the world economy $60 trillion and destabilized democratic societies around the world. That's a heavy indictment.
Time of the gentlelady has expired. The chair now recognizes the gentleman from Michigan, Mr. Huizenga, chairman of our Monetary Policy and Trade Subcommittee.
Thank you, Mr. Chairman. I appreciate that. And gentlemen, good to see you all again. And Mr. Silver, we have something that we agreed on. I heard you say that the Dodd-Frank bill was a compromise piece of legislation. And by that I assume you mean a compromise between Senator Dodd and Representative Frank, because there weren't any Republican votes for that during that time. But I do want to touch on a couple of quick issues that Mr. Atkins had touched on, and I'm going to go a little different direction because of some of the work that we've been doing on the committee. First is pay ratio. The rule is expected to come out, I believe, this next month. From the SEC. I had opportunity to question Chair White back in March of this year, and her quote from an October 2013 speech was that seeking to improve safety of, I'm sorry, that's my next question. The pay ratio rulemaking, really the SEC didn't have any experience or expertise in this. And at the time, it seems the SEC doesn't know exactly where it's going when it's whether it's going to include part-time employees, contract employees, which may be temporary workers, it may be the cleaning crew that comes in, that gets hired to come in, much less overseas employees. So if you would maybe quickly touch base on that pay ratio provision that's required, and what you expect as a former SEC commissioner, what might happen.
Yeah, well, I think it's an unfortunate diversion, frankly, from what the SEC should really be focused on. It was a sop to special interests who are, who have their own axe to grind in that regard. And then, as you touched on, definitionally, it's very difficult to implement. So I know the staff at the SEC is struggling with how exactly to put this thing together, and I expect that there will be yet another divided vote. Up until the time that I left the SEC in 2008, I don't think during my time there was any rulemaking divided vote upon partisan lines, and unfortunately that number has skyrocketed.
And that's been very common, correct?
Exactly. Under this administration it's been very common.
Yeah, I do want to quickly move on to something else that has had great impact on manufacturers. I, in West Michigan, I'm very tied to the car automotive industry. We have a tremendous number of Tier 1, Tier 2, Tier 3 automotive suppliers that are dependent on rare earths for their products and the products that are put in. This is where, in an October 2013 speech, Chair White had said that wholeheartedly may share some of the compelling objectives as a citizen, but as chair of the SEC, I must question as a policy matter the use of federal securities laws and the SEC's power of mandatory disclosure to accomplish these goals. She's talking about the conflict minerals. I had an opportunity yesterday, just yesterday, to meet with the Rwandan ambassador, Matilda Mukana Tabana, the Minister of Mines, Mr. Imena, and a mine owner, Emery Rubagenga, who came to my office expressing grave concern. The $20 million that the government of Rwanda spends on its mining operations, $2 million of that is spent for exploration and surveying. $5 to $6 million of that is spent on trying to comply with Dodd-Frank conflict mineral rules. My fear is that there's a huge impact on our manufacturers, while other manufacturers throughout the world are not subject to those same rules, and it's having little or no positive effect to those it was intended to help. And this committee had a subcommittee hearing, I guess, a term or two ago, where we had some folks from Democratic Republic of Congo in expressing that exact same thing. And I think it is imperative upon us. Again, I would agree with Chair White, some very laudable goals and objectives that are missing the mark because they are not truly helping those who are trying to escape that conflict, and it's certainly not helping the United States and our manufacturers as we are trying to compete in a world economy. So, Mr. Atkins, you had touched on that, so maybe a couple of seconds on that.
Yeah, no, I agree. I think it's really unfortunate that Congress foists on the SEC these disclosure provisions that have nothing to do with materiality with respect to public issuers. That is the basis of the 34 Act, the Securities Exchange Act, and to go off and try to do social engineering through the securities laws and disclosure, I think is really unfortunate.
And I'll mention that her response to a letter is the SEC had spent over 21,000 hours and approximately $2.7 million on that particular provision, and to what end?
Time of the gentleman has expired. The Chair now recognizes the gentlelady from New York, Ms. Maloney, ranking member of our Capital Markets Subcommittee.
Thank you, Mr. Chairman and Ranking Member, and all of the panelists for your testimony today. And we need to remember that Dodd-Frank was a sweeping overhaul of our entire financial regulatory system that was brought on by the largest financial disaster in our history, where we lost, according to the GAO Independent, $22 trillion. Tens of millions of people lost their jobs. Millions were out of work. And the economists that testified before this committee and others said that this had the economic shocks that were 3 to 5 times stronger than the Great Depression, and it was caused by mismanagement of the financial system. And it was the only financial crisis that was totally self-inflicted. And I don't want to go through it again. So I'm proud of any effort to stop any type of financial abuse. But one of the principal goals of Dodd-Frank was to improve the safety and soundness of our core banking system, and it was a response to a crisis that showed that many of our largest banks did not have nearly enough capital or nearly enough liquidity. So it's important to point out that 5 years later, the biggest banks have more than doubled the amount of capital they hold. In fact, they now hold more than $1.1 trillion in capital, and the biggest banks have also nearly doubled their liquidity since the crisis, and they go through now a required annual stress test by the Federal Reserve that the IMF calls state-of-the-art. So I believe that Dodd-Frank has successfully achieved its goal of shoring up safety and soundness of our banking system that serves our people and serves our country, making it stronger and more resilient. And this will make future financial crises less likely, and I am proud of that achievement. Now I would like to ask Mr. Silvers about an important financial reform that we passed before the crisis, during that crisis, that I authored, worked on it 4 years. It was called the Credit Card Holders Bill of Rights. Now, some on the panel have claimed that it harmed consumers, but there were 2 important studies, and I'd like to put them into the record. I don't have them with them today. One done by the Pew Foundation that said this bill alone saved American consumers $10 billion a year. $billion a year. Another, a joint report from New York University, Columbia, and another university, claimed it saved a whopping $20 billion a year. I call it the Maloney stimulus package, because I, for one, would like to keep that money in the hands of consumers and not in institutions that, by all accounts, were performing, not all of them, unfair, deceptive, abusive, and anti-competitive practices. So I would hear stories. It was hard to walk 2 feet without hearing a credit card story. One man was promised $8,000 on your interest. You can buy a car. He bought a car. 2 months later, the financial institution raised his interest rate to 30% a year, 30%. He was trapped in debt. He paid off the car 2 or 3 times. He couldn't get out of debt. And so the Credit Card Bill of Rights cut out lies, cut out abusive practices, and made it fair. Now banks tell me, and the Consumer Financial Protection Bureau, that they get very few complaints on credit cards. People are not complaining because they're fair, and that's what we want. We want fair practices in our financial system. So I'd like to ask Mr. Silvers about the Credit Card Bill of Rights, the CARD Act. By the way, Rahm Emanuel told me that it continues to poll better than anything the administration ever did, because it touched every consumer in this country, and I would say that this was a bill that passed with the support from both sides of the aisle overwhelmingly. Do you think the Credit Card Bill of Rights is abusive to American consumers? Do you think keeping their money in their hands is an abusive practice? I'd like you to expand on this, if you would, Mr. Silvers.
We'll have 17 seconds to do so.
We can take your written testimony.
I'll just say this. What I think is not as important is what people who've done peer-reviewed academic research think. And what the premier study in this area that was done by a team from the University of Singapore and the University of Chicago found that for lower-income credit card holders, those with FICO scores with credit ratings under 600, the act and the banning of the tricks and traps you were talking about reduced credit card costs by 5.3% of balances. It's a very big number, and did so without impairing access to credit in any way they could detect.
Time of the gentlelady has expired. The chair now recognizes the gentleman from North Carolina, Mr. McHenry, Vice Chairman of the committee.
Well, happy anniversary. America has been saved. We're just living with the consequences of that savior, Dodd-Frank. And the consequences of that are lower growth, impaired lending for community institutions and large institutions as well. It means we have less job creation than we otherwise would have. And historically, Dodd-Frank is an anomaly in how Congress has legislated. And so, Dr. Calabria, I want to ask a little bit about this. So if you look at the last major crisis that my Democrat colleagues point to and say that this was an analogous situation we've lived through, and that's the Great Depression. So out of the Great Depression, you had the Pecora Commission that reviewed the finite causes of what they were experiencing. You had Congress in a bipartisan way, did they not, write securities law with the 33 and 34 Act, right? These were not partisan endeavors as a result of that great crisis. Is there some context you could provide to that, Dr. Calabria?
I appreciate the gentleman's point. First let me respond to an earlier point. We all agreed the crisis is bad. I don't think anybody here disagrees with that, certainly not on the panel. I think we all agree we'd like to avoid future crises. I don't think there's any disagreement on that. I think we all agree that in the crisis we should have done something. The question is, what should it have been? I would have preferred debt-to-equity swaps that would have imposed losses on creditors and recapitalized the banks very quickly. I will note we certainly didn't do nothing during the Great Depression. Lots of things were done, many things, in my opinion, that made it a longer. While we do not know what the counterfactual would have been had we done other things, I'm always puzzled by the argument of it was really bad, so I'm glad we did this. Well, maybe it would have been so bad if we hadn't. Personally, I think, and again, this is not a partisan issue, because I think when a Republican president and a Republican Treasury Secretary go on TV and say, if you don't pass X by Monday, we won't have an economy, if that doesn't cause panic, I don't know what will. So, again, I think we need to get away from the keeping score. I think it's unfortunate to me. Certainly, you go back and you look post-S&L crisis, things like Fiducia, FIREA were all passed with large bipartisan numbers. I do think it was possible to get a very good bill that would have gotten, say, 80 votes in the Senate and would have been very bipartisan here if we had gone that path. I think that was doable. It would have looked very different. Some of the things that, to me, don't have anything to do with the crisis, like the pay ratio, there's literally more discussion in Dodd-Frank about payday lenders than there are about Fannie Mae. Who thinks payday lenders caused the crisis? Whatever you think about them. Really? Okay, thank you. My point is, I think we could have done this better in a way. It would have been narrower. I think there are a number of things that are still off the table. But again, this is not about wanting to relive nobody wants to relive this again. It's really a question of, did we do something that was effective? Let me end with saying, I worked on the Housing Economic Recovery Act, proud of my efforts in it. We failed to avoid the failures of Fannie and Freddie in that act. I'll own up to we didn't get that bill done right. Too little, too late. I'm willing to lay that on the table. I think if we could all own up to the mistakes we made, I'll actually point to anybody who looks at it. I've done a couple of blog posts on mistakes I made. So I'm willing to...
reclaiming my time, Dr. Calabria. Although you were rolling, sorry to interrupt, but I do want to get to a couple other points, which is Dodd-Frank didn't eliminate risk in the financial system. It moved risk. The claim is that it mitigated risk, but there's a movement into a different array of new risky institutions. So financial market utilities, very important. Even more important post-crisis than pre-crisis. And there's a grave concern that there's a new group that will need a bailout going in the event of another crisis. So in that regard, Dr. Calabria, not to interrupt your train of thought, but the concerns there that we have global clearinghouses that are so important here, what does that look like?
So I very much fear that we will have to provide assistance, if not actually have to bail out a clearinghouse. As we know, Dodd-Frank allows access to the Federal Reserve's discount window for clearinghouses. It's important to keep in mind, there are essentially two risks, the instrument risk and the counterparty risk and derivatives. What we essentially did was centralize that counterparty risk. It did not go away. It didn't go poof. It just went all in one place. Again, I would say we should learn from the lessons of Fannie and Freddie. When you concentrate all the risks in a few nodes, you really do make systemic risk greater, not less.
And I yield back.
Time of the gentleman has expired. Chair now recognizes the gentlelady from New York, Ms. Velasquez, for 5 minutes.
Thank you, Mr. Chairman, and I want to also thank the ranking member. Professor Siwicki, in your testimony you stated that CFPB was to blame for a decline in new business starts. Are you aware that the Small Business Administration is on track this year to having the highest record of small business lending since the Dodd-Frank was enacted? And also the NFIB, in the latest report of small businesses, show that the optimism index is at its highest since Dodd-Frank was enacted. You even cited a report by the Brookings Institute, and I have it here. I read that report, and there is no mention, sir, of the CFPB as a cause for that decline. In fact, the authors say allowing more highly skilled immigrants into the U.S. may reverse this downward trend. By the way, I should tell Mr. Donald Trump that he should read this document and this study, since he said that Latinos are going to love him because he's going to be the president creating jobs. Well, this is the answer to creating jobs. Instead of dismantling the one federal agency that looks out for consumers and has refunded them $5.3 billion, do you think we should instead focus on immigration reform to help spur small business revival, as the authors actually stated? Since you brought this study, I think it's a fair question.
Well, I would focus on immigration reform as well as fixing Dodd-Frank, and I totally agree with the idea of more immigration for legal immigration for high-skilled workers is undeniably, in my view, a boon to the American economy. In my
but that is
personal opinion.
That is the central point of this study. It wasn't that
what the
Dodd-Frank
study showed,
or CFPB was the cause.
what we know about it, according to a paper in, I think, 2009 by Tom Durkin, a former Federal Reserve economist. He documents the number of small businesses that rely on personal credit in order to start and grow their businesses, credit cards, home equity loans, and even in my own research, auto title loans, things like that. And that people rely on these for these kitchen table businesses, landscaping businesses, handyman businesses. They use their own personal credit to do this. And I don't remember the exact estimate, but he documented the fact that drying up access to personal credit would damage small business growth and creation. The Brookings study that I point to notes that for, I think it was 2 years ago, for the first time in American history, more businesses were destroyed than were created. That's what that Brookings study shows, and a lack of access to consumer credit for small businesses, I think, is undeniably a contributor to that.
Well, sir, there's no mention of CFPB on this study. Mr. Silvers, as you know, the Dodd-Frank Act was a complex framework to shore up the financial sectors to prevent future economic collapse. 5 years later, can you tell us what work remains in terms of fulfilling the original intent of Dodd-Frank?
Congresswoman, there are significant regulatory steps that remain to be taken. In my view, one of the most significant is the Federal Reserve issuing the rules around executive compensation and excessive risk-taking within financial institutions that have been delayed since 2011. And similarly, the SEC issuing the executive pay ratio rule to median employee, which is an important source of information and check on excessive executive pay in public companies, has been mandated by Congress and not issued. On the statutory side, as my testimony went through, there are a series of structural changes that are necessary if we want our financial system to do its job, including to provide credit to small business. The key ones that have been identified over and over again by financial regulatory experts are the separation of stock market activities and derivatives from federally insured commercial banking, essentially the restoration of a modern Glass-Steagall Act, a more aggressive approach to regulatory capital on a size basis, and a financial transactions tax.
Time of the gentlelady has expired. The chair now recognizes a gentleman from New Jersey, Mr. Garrett, Chairman of the Capital Markets Subcommittee.
I thank the Chairman for holding this very important hearing. The ranking member started out by saying the crisis of '08 was not a natural disaster, and I agree. It was inflicted. As a matter of fact, the ranking member of the Capital Markets Committee said it was self-inflicted, which I tend to agree as well. But who was doing the infliction is the question. Mr. Silvers, you indicate that there was a failure of regulation and failure by the regulators, and I would agree to that. But you also said that they did not have the authority to prevent the crisis. That is factually incorrect based upon the multiple hearings that we had in this room. 7 years ago, after 2008, Chairman Barney Frank at the time had multiple hearings, brought in the regulators at the time, and I and others specifically asked each and every regulator, knowing now what happened, did you have the authority in your area? They all said, yes, we did. Did you actually have personnel stationed in the banks that failed? Yes, we did. So they had people, staff members working in these very banks that failed, that involved themselves in these risky trades and what have you, but they had the authority, at least they testified it to us repeatedly at the time. You know, back at that period of time, my predecessor as chairman at the time was Paul Konjorsky, Democrat from Pennsylvania. He said what we really needed was to, he said this many times, to have greater market discipline. I don't know, I see some nodding heads by the panel here that would have been a good thing then, and I see nodding heads that would probably be a good thing now. The question is, how do you come about getting that? Well, let's see. Do you get more market discipline by increased regulation? Again, Mr. Silvers, you told us in your testimony just now that the regulators are still not doing their jobs. I'll just throw a question out. Mr. Atkins, who is it, which administration appointed the current SEC chair?
The current administration.
And which administration appointed the current Federal Reserve chair?
The current administration.
Which administration appointed the head of the CFTC currently?
The current administration.
And how about the CFPB?
The same.
So if Mr. Silvers is correct that the current regulators are not doing their job, which administration is responsible for appointing all of those regulators?
Yeah, the current one.
Oh, okay. Right. So the solution then perhaps is not looking to this administration for additional regulation or additional regulators. Of course, as Mr. Silvers pointed out, they're not doing their job still. And if Mr. Konjorsky is correct that we need additional market discipline, is the answer, I'll throw it to Mr. Atkins, additional regulations? Is that the solution, or is it additional market discipline?
Yeah, I think I agree with you, additional market discipline. I think it's really not correct to say that there was no regulation or deregulation, especially in the wake of Sarbanes-Oxley and that sort of thing.
Okay.
There's enough to fill a big rule book.
Well, that's true, because, you know, the ranking member also started out her testimony by saying it was death by 1,000 cuts, what's happening now, she is asserting. Would you suggest that maybe we have the reason we have the doldrums in the economy and the fact that we're in a morass as far as job creation and the rest is actually death by thousands of pages of regulation?
Yeah, that's true. It's costly to comply.
And does anyone, I'll throw this out to the panel as well, does anyone actually know the total cost of all these regulations based upon the testimony that we've heard in this hearing previously? And does anyone actually know the implications of the overlap capital requirements of these regulations? I'll throw out to Mr. Calabria or Mr. Atkins, I guess.
Well, I'll say one thing real quickly is that it's not just the out-of-pocket expense to comply, but it's also the uncertainty and all the latitude that the regulators have to second-guess.
We had hearings on this. We asked the head of the Fed. We asked the head of the Treasury Department, do they actually know the cost? And Secretary Liu's response was no, and he said that's our job to figure that out. But I'll close on this in 29 seconds. Mr. Atkins, then, since even the people, the regulators who are told are not doing their jobs, and even though they tell us they can't compile the total cost to the economy of Dodd-Frank, are you able to make an assessment whether it's a positive or a negative impact?
Oh, I completely think that Dodd-Frank has a negative impact.
And it's a negative impact on liquidity, credit availability, and job creation?
All of those, yes.
Okay. I'll yield back.
Gentleman yields back. Chair now recognizes the gentleman from New York, Mr. Meeks.
Thank you, Mr. Chairman. Thank you, Ranking Member. I get confused sometimes, but I think I heard Mr. Calabria say that he agreed that we did have a crisis in this country. Is that correct?
Yeah, I'm not sure anybody disagrees with that.
So, but because I want to make sure, does anybody disagree with the fact that there was a major crisis in this country? Okay. Now, so when we had this crisis, you know, we who are members of Congress represent this country. We've taken an oath to try to do the best that we can for this country. So something should be done when you had this crisis, because we were in free fall. If I recall, and I can recall individuals coming to tell me that if we didn't do something and do it quickly, our whole financial structure would be in failure, and as a result of that, not only would we be devastated, but the financial institutions across the world would be devastated. That's how bad it was. In fact, I can recall that we first voted to do nothing, and then we had to come back because the stock market fell about 800 points, and everything was going in, and there was panic. And and at that time it wasn't that, because I heard some people say, well, under President Obama wasn't here yet. So he didn't cause this crisis. Can we all agree upon that?
Nobody here is blaming the crisis on President Obama.
So, this crisis happened, things was done, and at that time, you know, the regulations that you're talking about that are costing a lot of money now, we didn't have anything in place then. And so that was, you know, things were starting to fall and we're going down. Now, we passed Dodd-Frank. And I'm the first to say that I don't know, since I've been in Congress now close to 18 years, I don't know of any perfect bill. So I'm not claiming that Dodd-Frank is a perfect bill. But I do know that as we put things in place in regards to Dodd-Frank, and I do know that there were some Republican ideas. Maybe we didn't get a single Republican vote, but I do know that Mr. Frank worked across the line and got Republican ideas and put those ideas into the Dodd-Frank legislation. So it was, in fact, not just Democratic ideas in Dodd-Frank, it was both Democratic and Republican ideas in Dodd-Frank, but politics dictated that no Republican vote for it. But it was, in fact, when you look at the document itself. So, here we are now, 5 years later, and as I look at the title of this hearing, Dodd-Frank Act 5 years later, are we more stable than we were then? And from what I'm hearing from all of you, where we were then, we were not stable at all. We were headed downhill into catastrophic areas. So I think that just by the very logic of the hearing itself, that any logical person would have to say 5 years later, we are more stable with Dodd-Frank than we were without Dodd-Frank. Because Dodd-Frank didn't exist 5 years ago, and we were in bad shape. And we are in better shape now, so there's no question that we are more stable now than we were then. And in fact, from what I hear, especially with private sector jobs, I understand that the private sector has created over 12.8 million new jobs over 64 consecutive months of job growth. And I know before then, we were losing 400, 500,000 jobs per month. So we have to be in better shape now and more stable now than we were then, just based upon sheer numbers. Normal household net worth has grown by about $30 trillion, exceeding the pre-crisis levels. So you may have your issues with Dodd-Frank, but you can't tell me Dodd-Frank is what caused some, you know, we have problems, is because of Dodd-Frank, because without it, we were in catastrophic problems. With it, we're moving in a better direction, and yes, I'll grant to you, it's not a perfect bill, and maybe there need to be some fixtures where we can work together on. But to say, what I'm hearing from some, let's do away with Dodd-Frank, to me that says let's go back to 2008, and that we cannot do.
Time of the gentleman has expired. The chair now recognizes the gentleman from Texas, Mr. Nagelbauer, Chairman of the Financial Institutions Subcommittee.
Thank you, Mr. Chairman. Mr. Sweeky, you've spent quite a bit of time in your academic research on consumer credit issues, and I have a bill 1266 which would take the CFPB from a single director to a 5-person commission, which I think would make that a more stable and sustainable organization. Could you elaborate on how that would help make it a more consistent and stable organization if it was a 5-person commission?
I would strongly endorse that legislation, which is that the fundamental problems of the CFPB go back to this fundamental defect in the way in which it's structured, which is no budgetary appropriations, a single director, supposedly removable only for cause. And we've got decades of academic studies on bureaucracies and how bureaucracies behave when they're not subject to democratic accountability, and the CFPB is basically the poster child for how that operates. I think over time we have learned that there are two ways that we can structure agencies. Is an executive agency like a department accountable to the president through the democratic process, or a bipartisan agency. And I think for an entity like this, the Federal Trade Commission is exactly the model that we need. The Federal Trade Commission has been around for 100 years. It's a bipartisan agency on budget, and it does more or less exactly the same thing as the CFPB. And I think the FTC has proven the test of time as an agency that is responsive, that takes into account the impact on the economy, questions like competition and consumer choice with respect to any product. And I think that is not only a good idea for this agency, but really the only way that we're going to get this agency back on track and really looking out for the American consumers rather than their own narrow bureaucratic empire building.
Well,
I was going to just simply remind the committee that the original proposal for the CFPB introduced by Senator Kennedy, written by Elizabeth Warren, was a 5-member bipartisan position in the appropriations process. So you go back and look at that bill, not some radical free market proposal.
Yeah, and I think when the purpose of this hearing is to talk about are we more stable, and one of the things that when you look at consumer credit, how you design consumer credit or restrict or enhance consumer credit has long-term ramifications, doesn't it, for the economy long-term?
Absolutely. It's the engine for the economy first, but more important to me, it is the engine by which people make their lives better. It's the way, if you need you cannot wish away the need for credit. If you need $500 to fix your transmission to get to work on Monday, or you lose your job, you need $500 regardless of whether you got it in the bank or not. People use consumer credit to make their lives better. And when we shut off access to consumer credit, when we take credit cards out of people's hands, when we take bank accounts out of people's hands, when we take mortgages out of people's hands, we are making their lives worse off. And I think that is a real tragedy, not only for the economy at large, but for every single American family.
Mr. Atkins, you served on the SEC, which is a commission. Did you find that that was a productive organizational structure?
Yeah, there are benefits and detriments to it, right? But I think the problem with the CFPB, of course, you can work on procedure and organization, but you also have to look at other aspects of it. I think the current construct of it, has constitutional problems, appointments clause issues, separation of powers issues, and those sorts of things. And then also just the substance of the statute, Dodd-Frank, that empowers it and has sort of vague statutory provisions like abusive practices and how that's defined. I think those substantive aspects are important as well.
In that interaction with really, in sometimes different political viewpoints, different, opinions, you didn't always get, things the way you wanted. It looks like to me it promoted dialogue and some negotiation, whereas where the current structure, there is no negotiation.
Right. Well, and as I mentioned before, back when I was there, I don't think there was any divided bipartisan lines vote on rulemaking, and that just shows that I think there was a lot of give and take between the different sides.
Mr. Silvers, is the AFL-CIO governed by an executive committee?
The AFL-CIO has a president that has day-to-day management authority.
But does he add, does he responsible to a board of directors?
Yes, he is responsible to the Executive Council of the Federation, which meets twice a year.
Thank you, Mr. Chairman.
Time of the gentleman has expired. Chair now recognizes the gentleman from Massachusetts, Mr. Capuano.
Thank you, Mr. Chairman. Mr. Chairman, I've heard a lot of interesting philosophical talking points this morning, but I've heard them before, and I'm sure I'll hear them again and again and again and again. But I haven't heard too many figures. From the panel, I only heard one statistic, and that's that there are fewer people with free checking than there used to be. My God, what a terrible crisis that is. People have to pay for a service. That is complete ruination to our system. Yet, some other statistics I have show some things from the day of Dodd-Frank, July 21st, 2010. The Dow Jones was at 10,120.53. As of yesterday, it was 17,776.91, and today it's up a little more. That's a 76% increase, and that's true about all the markets. Dow is just being one, but it's true about S&P, it's NASDAQ, and all of them are. The unemployment rate, July 2010, was 9.4%. Most recent one in June is 5.3%, the lowest it has been since before the crash. Average house price on July 2010 was $252,100. Today, as of May 2015, it's $337,000. That's $84,900 more, a 34% increase. The GDP in July 2010 was $14,784 billion. Today it is $16,288 billion, a $1.5 trillion increase, a 10% increase. Housing starts. July 2010, there was 604,000. In calendar year 2014, there was 1,046,000. 442,000 more, 73% increase in housing starts. Total construction value, also a 19% increase, and on and on and on. Could Dodd-Frank be better? Yeah. As a matter of fact, I have a proposal because I agree with some of my friends that too big to fail. I think we did some good work. I think we didn't go far enough. And I would love some of my colleagues on the other side to join me in reinstituting Glass-Steagall. I voted against the repeal of Glass-Steagall. Join us. Bring it back. If you don't want to do that, join us in trying to deal with other issues. I have a proposal how H.R. 888 that not a single Republican will join, yet it is supported by the community bankers, the people you say you care about. They're looking for a Republican co-sponsor. We can't find one. And by the way, it's not my idea. I simply took the idea of an economics professor from Boston University and a scholar at AEI who happened to be the former chief counsel to Ronald Reagan. Not my idea. But yet, can't do it, can't touch it. We can only talk about repealing Dodd-Frank and how bad certain sections of it. Why don't we get to fixing the problems we have? I've had my fights with the CFPB. I've certainly had my fights with the SEC and the Fed. Mr. Garrett and I have a bill to deal with some of the issues we have with the Fed. Now, if Scott Garrett and I can agree on an issue, we can find common ground with everybody over there. But yet, can't be done. Why? Because if you actually try to fix the problems you identify, as opposed to pontificate about them, you don't get any points with the outside groups. Fixing a problem is a problem in and of itself. We're here to pontificate, and we do a heck of a good job. So for me, all very interesting, but numbers don't lie. The numbers are almost all good. Are there a few bad ones? Yes. Can we do better? Sure we can. Are we going to do better by simply nitpicking at everything? Now, nitpicking is not a bad thing, but nitpicking is what you do once you've fixed your other problems. There has not been one substantive proposal to deal with too big to fail from the other side. Not one. Yet, we still love to complain about it. That, Mr. Chairman, I yield back. I actually thought I wouldn't take the whole 5 minutes, but I'm glad I did.
Gentleman yields back. Chair now recognizes the gentleman from Missouri, Mr. Lukemeyer, Chair of our Housing and Insurance Subcommittee.
Thank you, Mr. Chairman. One of the things I want to talk about is the Financial Stability Oversight Council, FSOC. We're talking about, are we more stable as a result of Dodd-Frank? FSOC was a creation of Dodd-Frank, supposed to judge the stability of our economy and how we're doing. And one of the things that they're empowered to do was to identify different risks within the financial system, and in particular, banks and non-bank, non-financial institutions, if they're systemically important. And so we have, at this point, FSOC has evaluated and designated 3 insurance companies and 1 finance company as systemically important. An insurance company, systemically important, so that if it goes down, the entire economy goes down. Dr. Claby, would you like to comment on that? Is that possible?
Well, first let me say, I think often we're given, to me, the false choice of bailout or liquidate. Many of these institutions can be kept running, can be reorganized. Again, my proposal during the crisis was to do a debt-to-equity swap as a recap that wouldn't have cost the taxpayer. So I'm of the view that no one institution is so special that we need to put taxpayer money in and can't be resolved without a reasonable bankruptcy framework. So that said, insurance companies are very different than banks. They don't have short-run runnable. Some of the analyses you've seen, particularly in the MetLife case, is just ridiculous. So for instance, the FSOC asserts that because state regulators can place stays on policyholder redemptions, that the state regulatory system for insurance itself is a source of systemic risk, according to FSOC. So it seems like if you go back and read these justifications, quite frankly, they all look like they're made up. And if I could channel the good gentleman who left the room, no numbers, no statistics, all just opinion.
Okay. Yesterday we had a hearing with regards to systemically important financial institutions, and we're looking at the mid-sized and regional banks. And it's interesting because there's a lot of folks, in order to be able to I have a bill to try and define that rather than have criteria for it versus a strict threshold. And it's interesting because they're trying to redefine what supposedly was in Dodd-Frank, which was to define those entities that would be able to bring down the entire system. Now they're trying to redefine it as something that would happen on a regional basis or whatever. And so it really strikes to me at the heart of the ability of FSOC and other entities within this to be able to adequately point out risk. And along that line, we had Secretary Lew here a couple weeks ago, and he gave us the official report, the 2015 annual report of FSOC. And in there's 11 different risks that he pointed out that were important to be able to be aware of and watch and take very special note of. And one of them that was noted that very same day that he presented this as a report to us was the CBO came out with a scathing report that talked about our debt. Can you believe that debt was not even listed as a risk to our economy? It strikes at the very heart of what I believe is the credibility of FSOC to be able to even analyze what is wrong with our economy. Professor Zawicki, would you like to comment on that?
I don't think I have anything to add other than it seems obvious to me that you're correct.
If I could add, well, I've got some skepticism about the Office of Financial Research. If we're going to have it, it should be independent of Treasury. I've read these reports and they're very dismissive of concerns about the Treasury market. And ultimately, OFR has essentially been set up to be a political research outfit for the Treasury Department, which by its very nature is a political animal.
Okay.
If we want independent research of the financial system, it needs to be independent of politics.
Okay, along the lines of what I was talking about, though, with regards to credibility of FSOC, and some of the concerns with regards to debt. Dr. Klebe, in your testimony a minute ago, or a little while ago, you talked about the explicit and implicit guarantees and the extreme amount of liabilities that our government has as a result of the Richmond Fed study. Would you elaborate just a bit on that very quick? I have about 30 seconds left here, about how important it is to have all of this data and look at the big picture of what kind of risk and system and actual stability we have with regards to all that?
Absolutely. So, and first I'll direct anybody who's curious to go to the Richmond Fed's website where their bailout barometer is there. And what they try to measure is, A, the explicit guarantees we know about, such as the expansion of deposit insurance. And so, as I mentioned in my testimony, we have $2 trillion more in insured deposits than we did before Dodd-Frank with that expansion. And they also try to estimate the implied guarantees. And of course, we have no way of knowing an exact number, but these are the potential guarantees that the taxpayer is on the hook. And as was mentioned in the Chairman's opening statement as well as mine, about 60% of financial liabilities in the financial sector are either explicitly or implied to be backed by the taxpayer.
You're back.
Time of the gentleman has expired. The Chair now recognizes the gentleman from Missouri, Mr. Clay, Ranking Member of the Financial Institutions Subcommittee.
Thank you, Mr. Chairman, and thank the ranking member for calling this hearing today to celebrate the 5th anniversary of Dodd-Frank. Let me start with Dr. Calabria about the housing crisis, and you say in your testimony that you don't believe we have sufficiently addressed the distortions in the housing industry. Let me ask you about mortgage modifications. Do you think that will help our economy? How do we help those homeowners that are underwater and make them whole, who for the most part were steered into high-cost predatory loans? Do you have any?
So first of all, the first thing to do about trying to help an underwater homeowner is to not get them underwater in the first place. So for instance, historically, 1 in 4 FHA borrowers left the closing table underwater. If that's not reckless, I don't know what is. So and as Congressman Frank said here last year at this very table, he intended for down payments to be part of QM, the qualified mortgage rule. As I mentioned in my testimony, regulators completely gutted that provision so that the two factors that matter most in terms of keeping a household out of foreclosure, which is the down payment, which gives you a cushion when prices fall, and of course trying to make sure borrowers are actually ready by us not getting people with very low FICO scores who are not ready into homeownership, I think we need to be a little more responsible. But that said, first try not to get in the problem in the first place. If you are in the problem, that's a different issue. And so let's talk about that because I know that's the more immediate concern. The immediate concern would be, how do we address the triggers that get you into that problem? So for instance, one of the things we know, tons of data on this, primary reason that somebody cannot pay their mortgage is because they've lost their job. So, and for instance, Congressman Frank, during his last year here, I believe, had a proposal, for instance, that would have provided assistance in mortgage modifications to people who have lost their job. So, so I think we need clear thinking about what are the drivers here, address those drivers directly. Obviously, a growing economy that creates jobs goes with that as well.
Let me, excuse me, not to cut you off, but let me share with you a situation in my district, for instance, in Missouri, where we have entire communities who were steered into these high-cost loans when normally they would have qualified for conventional mortgages. Do we write down principal? Or I mean, how do we address that to help these homeowners, to keep them from foreclosing, to keep them in their homes, and to keep neighborhoods together? How do we do that?
So first of all, in instances, and again, it's hard for me to speak to an individual case without looking at the case, where people were defrauded, they need to be made whole by the people who defrauded them, which in my opinion, the taxpayer did not defraud them. They need to be made whole by the institutions that defrauded them. So that's number one. I would remind us that there's nothing specifically about being underwater that triggers a foreclosure. There's nothing in the mortgage document that says, oh, you're underwater, we come take your home. In fact, it's quite the opposite. They don't want your home if it's underwater, if anything. So we do need to think clearly about what are the factors. As I mentioned again, the unemployment's a big driver. There might be unexplained health care expenses. We'll see whether health care fixes that or not. But you have to do with the life events that cause these sort of foreclosures. all that being underwater does is change your incentive whether to walk away or not. And quite frankly, I don't think we should reward that.
Yeah. Let me ask Mr. Silvers, can you share any solutions to the housing crisis and how we get people whole who happen to be underwater in their mortgages? Have you all addressed it?
Yes, Congressman Clay, you're pointing to one of the critical problems in the way in which we addressed the housing crisis, which slowed down our economic recovery and led the cost of the recovery to be borne by the people who could least afford to do so, with devastating social impact. The failure to restructure debt in the housing market and to instead insist that poor people pay the banks 100 cents on the dollar when every American business person in commercial real estate in a similar situation never does, right, is how we got the median net wealth of African American households from $18,000 to $6,000. The solution is simple. It is to restructure those loans around what the real value of that property was. If we had done so, and as my colleague, Dr. Calabria has said, if we had done so and forced the banks to restructure their capital at the same time, we would not have a too-big-to-fail problem. We would have a healthy housing market and a healthy small business consumer credit market.
Thanks, and my time is up.
Time of the gentleman has expired. Chair now recognizes the gentleman from Wisconsin, Mr. Duffy, Chairman of the Oversight and Investigations Subcommittee.
Thank you, Mr. Chairman. I just want to make a quick comment in regard to one of the championed agencies of Dodd-Frank, the Consumer Financial Protection Bureau. I'm not sure if any of the witnesses are aware of a hearing we had a couple of weeks ago, which was a takeoff of a hearing that we had a year ago in regard to racism and sexism at the CFPB. Angela Martin testified a year ago. A couple of weeks ago, Florine Williams testified. We've had a pretty robust debate about racism in America the past several months. And I got to tell you what, I'm astounded that Barack Obama hasn't said anything about racism and sexism at the CFPB. That Richard Cordray still has his position at the CFPB is amazing to me. That Senator Elizabeth Warren, who is the champion of this agency that brought Richard Cordray in, his protege, that she is saying nothing about racism and sexism. Their silence is deafening. Stunning. But that's a side note. I want to talk about the crisis. I think my friends across the aisle want to talk about markets and market failure. But if we look at the root causes of the crisis, wasn't there an issue with subprime mortgages? Wasn't there an issue with Fannie and Freddie, Mr. Atkins?
Absolutely. And you have to remember that when I think the figure of $22 trillion was thrown around as far as losses in the financial crisis. I don't know if that's correct or not, but you have to remember it was a bubble. It was a bubble created by federal housing policy, so most of that stuff was illusory.
Federal housing policy by Fannie and Freddie, right?
Right, among others.
Among others. And did we deal with, in your review of Dodd-Frank, do we deal with Fannie and Freddie reform in Dodd-Frank?
Not at all.
So one of the root causes of the crisis isn't even addressed in the Dodd-Frank Act. And we note that regulators were on the beat, and they didn't see this looming crisis. And so instead of faulting regulators, we've given regulators more power and authority. They didn't get it right in 2008. What makes us think they're going to get it right in the next crisis? I would also just note that as Dodd-Frank, as I watched from the sidelines as this bill was passed 5 years ago, there was a lot of conversation about the fact that we have to end too big to fail. It has to go away. We have to protect the American taxpayer. But I don't know if you've noticed, there's been a change of tone from my friends across the aisle, because now they'll go, whoa, 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 we actually haven't ended too big to fail. Sweeping, massive Dodd-Frank reform, right? And too big to fail still exists. Actually, Elizabeth Warren just came out with a new bill to say, guess what? Sweeping industry reform, and you still haven't addressed too big to fail, so now she has new legislation. Am I right, Mr. Atkins?
There's being introduced, yes.
Yeah. They admit that with all of this massive reform, they didn't get it right. There's still more to do. But I do want to move to the lack of liquidity, fixed income markets, the Volcker Rule regulation. You see that as a problem, yes?
Absolutely, yes.
And the cause of the crisis, do you think, or the cause of the lack of liquidity is Volcker?
To a large part, Volcker and other associated regulations, increased capital requirements.
And does that lack of liquidity, does that create more risk in the market?
Yeah, it just means there's less cushion there and less information as far as pricing.
So do smaller shocks have bigger impacts when there's less liquidity, Mr. Calabria?
Absolutely. And I would note, even the authors of Dodd-Frank recognized the liquidity constraints by purposely exempting treasuries and agencies from the provisions of the Volcker Rule. Let's not forget that a number of institutions in history have done themselves in by bad bets on the treasury market.
Does time heal this issue? If you see banks, because of Volcker getting out of the market-making game, is someone else going to step in and take that role? I mean, we just have to wait a little bit longer? How does this play out? Mr. Calabria or Mr. Atkins, either way.
Well, there's a lot of course, there's a lot of capital. Asset managers and just basic everyday people who are investing money in the markets are there. So these fixed income products are being held. It's just a question of, what is the market, what's the everyday liquidity of the marketplace.
I yield back.
Time of the gentleman has expired. The chair now recognizes the gentleman from Massachusetts, Mr. Lynch.
Thank you, Mr. Chairman. I want to thank the panelists as well. You've all been very helpful with the committee. I do want to just respond to my friend, the gentleman from North Carolina, who said earlier in this hearing, he said that, and I'll quote him, he said that Dodd-Frank is an anomaly. An anomaly, of course, being something that is deviates from what is regular or expected, what is standard. The only reason that Dodd-Frank seemed like an anomaly is because that's the last time Congress did anything, passed anything significant. And so if you're in an environment that is inertia, a do-nothing Congress, and you look at something that actually moved, that seems like an anomaly, but it's just the illusion that motion causes when you're standing still. I want to talk about, if we're going to go back to the crisis and sort of do some of this analysis on what went right and what went wrong, I actually opposed the bailout, the $700 billion in bailout we gave to the banks. So I got about 25% of my district, they don't even have bank accounts. I've got a very diverse district. And so we went and took their money, their tax money, gave it to these banks, $700 billion. And, if we're going to go back and look what we did, why don't we go back and look at that? Why don't we go back? And I'm not saying that some folks on Wall Street should go to jail. I'll leave that to a judge and jury. But some of their conduct seemed criminal. It really did. And we ended up taking taxpayer money, $700 billion, giving it to the banks. And like in the case of AIG, I remember $9 billion we gave them $70 billion to help out AIG. But $9 billion that we gave of taxpayer money was directly to satisfy the debt obligations that were held by Goldman Sachs. So it was just a pass-through. It went right in one door of AIG and then right to Goldman Sachs to $9 billion. And, paid bonuses to a lot of people who were at the heart of this. Like I say, I'm not saying they should go to jail, but I would say we should be revisiting the bonuses that we paid to folks that caused a lot of this mess. And we're not talking about any of that. We're talking about dismantling, Dodd-Frank. We're talking about dismantling the one and only Consumer Protection Agency that we created. So you got all these agencies out there. We got one, the CFPB, the only agency that we've created to protect the consumer. And we look back at the problem of the crisis and we say, by God, the thing we got to do is get rid of that CFPB, the one agency that's actually protecting the consumer. It astounds me that's how we view this problem in retrospect. I think that we would better serve the people who we represent if we try to figure out ways to help them. And sure, the CFPB is not perfect. It needs tweaking. We need to help it to be more effective, and we need to address some of the concerns that the gentleman just raised regarding their treatment of employees and the disparate impact of some of their policies. But Mr. Silvers, in this last minute that I have, would you think that there are other priorities that we could focus on in terms of really trying to get at the root of what originally caused the problem? Oh, the other thing that strikes me is getting rid of Volcker, allowing the banks to go back and do what they were doing before that got us into this whole mess. Trading on their book of business, I mean, it doesn't make sense. But Mr. Silvers, if you have any other suggestions that we might reestablish priorities here that would actually help the American consumer and the American people, I'd love to hear it.
Congressman, I think that, for starters, we've got to stop telling lies about what happened in the past.
Right.
And the notion, for example, that insurance companies had nothing to do with this, my memory is that AIG was an insurance company. All right. The notion that Fannie and Freddie caused this crisis, they contributed to it. What caused it was the very thing that Mr. Garrett was referring to earlier, which was the Federal Reserve had the power to act and let subprime providers of mortgages funded by our largest banks destroy our communities and then hand us the bill. Right? Until we stop telling lies, I don't see how we move forward.
Time the gentleman has expired. The chair now recognizes the gentleman from New Mexico, Mr. Pierce.
Thank you, Mr. Chairman. Appreciate the lively discussion going on here. If we were to pursue this last thought here that the subprime lenders are the ones who destroyed the communities, I'd kind of like to investigate that. Mr. Capuano said we ought to be digging a little deeper into it. Mr. Lynch had some good points about looking at the situation. So, Mr. Adkins, you said that in response to Mr. Duffy that Fannie and Freddie had something to do with it among others. Who might the among others be?
Well, we've had a long history of both Congress and...
I mean, anybody close to this room. Because Congress itself was expressing a tremendous desire that everyone should own a home. And home ownership was not a responsibility but a right. Is that somewhat correct? I'm sensitive to what Mr. Silver said. We shouldn't be telling lies here. So did Congress, led by Mr. Frank himself, suggest that the agencies, led by Fannie and Freddie, should loosen the standards by which they repurchased on the secondary market? Wasn't that occurring?
That was federal policy. Yes.
So would it be a truth that the financial institutions could not have continued to lend to borrowers who could not afford? They couldn't have done the liar loans, they couldn't have done the no-doc loans, if those loans hadn't been repurchased into the secondary market. Is that more or less correct, Mr. Calabrese? Dr. Calabrese, would you like to comment about that?
Well, let me first, as an aside, say none of this would have happened without essentially a Federal Reserve-driven bubble. The amount of liquidity the Fed just pushed into the system in the mid-2000s was simply nothing short of insane. And so prices drove a lot of this. But to get back to the point of, we know during the crisis, for instance, that at the top of the market, Fannie and Freddie bought about 40% of the private label mortgage-backed securities in subprime. And to echo what my friend Damon said, they were a contributor. I would never say that they were the sole cause by any extent of the imagination.
Could the subprime lenders have done much without the secondary market? And could the rest of the secondary market have dropped its underwriting standards without Fannie and Freddie dropping theirs?
They could have not have. So, I mean, again...
So, at the end of the day, Fannie and Freddie weren't just kind of innocent bystanders, or bystanders, I think, that was not a correct characterization of Mr. Silver's comments, but they were more central than what any of our friends on the other side are willing to say. The description is that the problem, and again, I think that, as Mr. Capuano said, if we don't analyze exactly why the problem came up, we're not going to get the right answer. And one of the fundamental things was that the underwriting standards by which the secondary market operated took bad loans away from the banks. They weren't given any incentive then to make the loans good, and that just seems like a very fundamental problem. Is that more or less correct?
That's absolutely correct.
Okay, Mr. Silver, would you like to comment about that? I'm sorry I can't see you, but I'm over here. Yeah.
Yes, thank you for the opportunity. There's a subtlety to this that the conversation's missing. What the subprime loans that triggered the crisis were largely in the private market and were largely securitized through private offerings. That created competitive pressure on Fannie and Freddie that had been privatized and whose executives wanted to hit the profit margins that would trigger their pay packages.
You're saying the competitive pressure, with all respect, sir, weren't the heads of Fannie and Freddie, didn't the head of Fannie Mae, Mr. Johnson, take about $100 million? Wasn't he beginning to change the standards of accounting? Didn't Franklin Raines take a $29 million bonus out of that? That feels like that they were driving the process themselves. In fact, if you read the book where Mr. Johnson was coming in here lobbying this group in order to change the rules and change the laws to where he could go ahead and make more, could bring more of the product into his market, that seems far different than kind of a nuance.
No, the nuance is not the fact that the executives of those companies sought to make a lot of money in disreputable ways. I fully agree with you. The nuance is that they were latecomers to the crisis. Fannie and Freddie bought bad securities at the very end that had been issued in the private markets. That's how they bankrupted themselves.
If that's correct, we're running out of time. If that's correct, how did Mr. Johnson make his $100 million? He was way ahead of the time. If Mr. Raines was in that period, I would yield back. Mr. Chairman, thanks for your diligence.
Time of the gentleman has expired. The chair now recognizes the gentleman from Missouri, Mr. Cleaver, ranking member of the Housing and Insurance Subcommittee.
Thank you, Mr. Chairman and ranking member. No matter what our ideology is, political affiliation or fussiness, facts tend to be extremely obstinate. They just are finicky like that. They just want to remain what they are. And so in this environment up on this hill, we have become, in a sense, a fact-free environment. Or in other words, if the facts don't fit, then bit by bit, we refit the facts. And it is so frustrating. And so I mean, you think about the CFPB has returned $5.3 billion to 15 million victims of unfair and deceptive practices. Dr. Calabria, do you believe that's a fact?
To the best of my knowledge, I haven't verified the number, so it sounds about right.
In Missouri, the number is about almost 4,000, I think, and which is a fact, incidentally. And I'm a little concerned. I mean, for example, we have, I chaired the Congressional Black Caucus, and I received complaints almost every single day from every agency in the federal government, from the Capitol Police to the people who work for the Forest Service. I would have done nothing as the chair but talk about discrimination if I had tried to just pour it out every day. And so the president can't, I mean, if the president says, I have a black suit on, he's going to be criticized in a few hours of bringing out the race card. If he said, Black Sunday, black market, anything. And so I think we need to really be careful on this whole issue of who attacks bigotry. And because there are problems in every single agency. Every single agency. I'm speaking experientially. Now, one of the things I wanted to ask you, Mr. Calabria, do you believe that the CFPB has in fact been responsive and flexible?
I mean, the short answer would be maybe the unsatisfactory answer would be depends. I mean, it certainly seems like that they've listened to a lot of people in the industry on some subjects. So, have they necessarily beat up on Goldman Sachs? Not that I could tell. Have they gone after Main Street lenders? It looks like it that way. So again, I think it's important to keep in mind it's not all one homogeneous response. It's been differed by industry. I do want to bring up a point, and first of all, let me very clearly say, consumers that are defrauded should be made whole by people who defrauded them. No debate about that. And we should be aggressive about that. The question over whether certain products should be available, that's a whole different matter. But I also think it's important to keep in mind whether somebody was taken advantage of by a debt collector can be a bad thing, and you should deal with it. It's not at all clear how that's necessarily connected to the massive housing boom we had. So you can have a fairer society that is less stable. You can have a fairer society that is more stable. Those are connected, but they're not necessarily the same thing.
So, a fact, was there a federal agency that was responding to consumer concerns and complaints and offenses against consumers?
In the finance world before
Dodd-Frank?
The financial rate, well, first of all, as a former staffer of the banking committee, I handled a lot of complaints and helped a lot of people, and I'm very proud of those efforts.
No, sir.
And that said,
that's not the question I asked you.
The Federal Reserve, OCC, HUD, I ran the RESPA office at HUD, and we spent a lot of time.
That's not the question.
You asked, were there, there were agencies. If the question is consolidating these things a good thing? May well be, depending on how you do it.
I know you're answering your question that you want me to ask.
My apologies.
My time has run out. You wouldn't answer
apologies.
my question. You're a nice person, though. I mean, I'm not mad at you.
The time of both nice gentlemen has expired. Chair now recognizes the gentleman from California, Mr. Royce, Chairman of the House Foreign Affairs Committee.
Thank you very much, Mr. Chairman. As we examine the Dodd-Frank Act 5 years later, and if I were to go down a checklist with the panel here, too big to fail continues. In fact, Dodd-Frank institutionalized it. Our secondary mortgage market remains in limbo, with Fannie Mae and Freddie Mac CEOs set to make $4 million now in salary on the backs of the American taxpayers who had bailed out Fannie Mae and Freddie Mac. Insurance regulation remains fragmented. Securities regulatory arbitrage is still possible with the SEC and CFTC as competing regulators. So I think the answer to the question, is our financial system more stable, as Dr. Calabria succinctly put it, I think the answer to that is no. Dodd-Frank abolished one failed regulator, the OTS, and gave us three more, the CFPB, the OFR, and FSOC. So the Office of Financial Research was set up to look around corners and identify potential systemic risks, to improve standardization of financial data and fill gaps in data collection, and support the FSOC in its work. That was the concept. And Mr. Atkins, as you know, the OFR performed an analysis of the asset management industry at the request of the FSOC in order to determine whether asset management firms should be designated as SIFIs and subjected to oversight by the Federal Reserve. The OFR's conclusions were described by SEC Commissioner Gallagher as, in his words, fundamentally flawed. And the inevitable results of the OFR not only inaccurately defining and describing the activities and participants in the asset management business, but also, quote, analyzing the purported risks posed by asset managers in a vacuum instead of in the context of the broader financial markets, unquote. Mr. Atkins, do you think this work of the OFR was flawed?
Absolutely. I thought it was a travesty, actually. I mean, you couldn't even describe it as scholarship. It was riddled with errors.
Last year, Congressman Murphy and I put forward a bipartisan bill, the Office of Financial Research Accountability Act. Members of this committee on both sides of the aisle have heard constant criticism about the quality of research at the OFR and the lack of real coordination between the office and federal financial regulators. The bill would address these issues, I think, in a very thoughtful way. The bill as drafted would require the OFR to submit for public notice and comment an annual report that details the office's work for the upcoming year. Additionally, the bill would require the OFR to coordinate with financial regulators when they conduct future studies. And I would ask you, I know you and I both might want to go further in reforms of the OFR, but would you support these balanced, bipartisan reforms to the office?
Yes, that's a great start.
And I'll ask Mr. Calabria this same question.
Well, I guess I'd say I've been here too long to think anything other than the devil's in the details. So let me say, conceptually it sounds good, but without having read the bill, I'd want to take a look at it before I would say anything stronger.
I appreciate your support, at least for the conceptual concept behind it, and I'll yield back the balance of my time to the Chairman. Thank you, Mr. Chairman. Thank you, panel.
Gentleman yields back. Chair now recognizes the gentlelady from Wisconsin, Ms. Moore, Ranking Member of our Monetary Policy and Trade Subcommittee.
Thank you so much, Mr. Chairman, and I want to thank the witnesses for coming here and bringing their tremendous expertise to this committee. I guess I'll start out with the Honorable Paul Atkins and talk to you a little bit about your testimony and your role as on the SEC. In your testimony, I think you make a lot of excellent points with regard to some of the misaligned incentives that people have had, that people have just generally in financial markets. And then you go on and on and on to indict various provisions of the Dodd-Frank Act, up to and including the fact that Dodd-Frank is 2,319 pages long. The bill that we got from Mr. Paulson was like 4 pages long, asking us for $700 billion. Just want to remind you of that. But I guess the question that I have is that I agree with a lot of points you make here, and I'm going to commit to really reading this in some depth. But I guess what I feel confused about is, or I have a question about, is while you seem to indict the free market, just laissez-faire, you don't really give us any prescription of what you would have done to prevent this crisis, other than to just indict the quote-unquote housing market, the purchasers of homes. I mean, people purchase their homes. It's like a one-time event for most people. And you don't seem to have much criticism for all of the guys in the fancy suits, the appraisers, the underwriters, the credit rating agencies, the private label mortgage originators, Lehman Brothers, Countrywide. And so I'm interested in hearing how you square that with housing policy. I mean, Countrywide and Lehman Brothers, for example, were not subject to CRA, and borrowers that came in were, as I said, people who do this once in their lives. They were not the appraisers. They were not the underwriters.
Yeah, oh, thank you. Clearly there were there's not just one thing that led to the financial crisis. And you have to remember a lot of the foreclosures had to do with speculators who were buying houses to flip them, and that was all encouraged by regulatory policy and other things as well. But I will point to one thing that when I was at the SEC that I pushed for a number of years, and that was reform of the credit rating agency aspect. And I think that was one of the big drivers, frankly, of the crisis, because people put way too much store in the AAA ratings and all of that from those rating agencies. And back in 2006, Senator Shelby pushed through a bill that of course, was enacted, the Credit Rating Agency Reform Act. And so that was at least a start, but the real problem was at the SEC, where there was no real process to allow for competition among credit rating agencies, and basically the big three, their word was taken as gospel, and that was a real fundamental problem that...
And a misalignment of incentives. I mean, people had to pay the credit rated agencies to then give them a good credit rating. And nobody is going to jail. I mean, I know people in my district who've gone to jail for, writing bad checks for $1,000, and yet these people are still walking around. Let me ask you, Mr. Zwicky, you say that Dodd-Frank has pushed consumers into payday lending and other non-traditional financial services. I guess I'm not familiar with those data that indicate that that's the case. So I'm not in love with non-traditional financial providers myself. But I wonder if that means that you welcome the activity of the CFPB to protect these consumers. I think my good friend, Mr. Cleaver, indicated that the CFPB has returned about $5 billion to 15 million consumers. And so I'm wondering how you think the free market would do a better job protecting these financial consumers other than the CFPB.
Well, what we know is that you can't wish away the need for credit. We've known that forever. We tried that in the past, right? We tried usury ceilings, that sort of thing, and we know how that ends. So in the 70s, or 1968, the United States Senate did a report, and they found that the second largest revenue source of the mafia was loan sharking. When Anthony Fat Tony Salerno, the head of the Genovese crime family, was indicted for loan sharking and breaking people's legs in 1973, he was running $80 million a day on the streets of New York City. Why? Because we had a regulatory regime that pretended like people didn't need credit. We're reliving this in fast motion, really. We've taken away credit cards, we've taken away bank accounts. People still need money. They're going to check cashers, they're going to payday lenders, and of course, the next thing we see in the sites are going after the payday lenders. And we know what happens when we take away payday loans. People bounce checks, people get evicted, people get their utilities terminated.
Excuse me, Mr. Zwicky, the time of the gentlelady has expired. As entertaining as Fat Tony is, the time has expired.
Thank you so much.
And we do need to move along. So, with that, the chair recognizes the gentleman from Florida, Mr. Ross, for 5 minutes.
Thank you, Mr. Chairman, and witnesses, I appreciate you being here. Specifically, Commissioner Atkins, you addressed something that I think is very important when we talk about systemically important financial institutions, especially as it relates to asset managers. I think what's even more compelling is that your pronunciation of the acronym for systemically important financial institutions as SIFI is just that when it comes to asset managers, science fiction. And I think that this is an unintended consequence of Dodd-Frank. What risk do asset managers have? I mean, they're essentially agents. They're not leveraged. And yet, here we are looking at making them a systemically important financial institution, as I understand it in your testimony, would then make that asset manager, as a SIFI or SIFI, jointly and severally liable for any other SIFI or SIFI that might have a need for liquidity. Is that correct?
Yes, I mean, under that, even for the bailout fund.
Yeah, exactly. And so what you've got here is you've got a non-leveraged asset manager now responsible, which really is not him, it's his investors who are responsible. And who makes up those investors? Mutual fund holders, pension funds, grandma and grandpas, people living on fixed incomes. So I guess what I'm getting at is here we are trying to find out if too big to fail is really something that has been put an end to with Dodd-Frank, but in fact it hasn't. Not only has it not, but it's given an incentive for another source of liquidity to bail out those that are deemed systemically important financial institutions. Would you agree?
Yeah, you can certainly ascribe.
And now, would you believe that just a couple of weeks ago, our Secretary of the Treasury, Jack Lew, was sitting there, and I asked him the question of whether a SIFI would be jointly and several liable for other SIFIs if they were deemed so, and he denied that. Looked back as his staff and denied it. And so I give you credit in your opening statement to not only recognize that as a plain anomaly, if you will, of the Dodd-Frank, but also to cite the fact that it's found in 12 U.S.C. section 5390. Mr. Calabria, let's talk about insurance just for a quick second. Now, we have probably in place one of the best systems of regulatory environment for insurance companies, and that's our state-regulated systems. Would you not agree?
Absolutely.
And now you've got FSOC coming in there and saying, well, there might be some gaps. We need them. We've got a federal insurance office that doesn't have any regulatory control, but yet we want to make sure everything's in sync. Would you feel that? Would you have an opinion as to whether there are some gaps there that would require a system better than what we have in place on behalf of our consumers?
Ian, so while certainly you can make some improvements to the state-based system, I don't think anybody would argue with that. I do worry that labeling these institutions as systemically important will create really bad incentives. So, let's give you a contrast. Whereas, say, J.P. Morgan's balance sheet is 40% long-term debt, MetLife's is only about 4 or 5%. And we know that being labeled systemically important, unfortunately, seems to send signals to the debt markets that you will be rescued, and it encourages you to be more highly leveraged. So, to me, I think we really risk, by putting insurance companies under this framework, we risk making them actually more leveraged and more dangerous.
More leveraged, greater capital requirements, more detriment to the consumer or to the insured, which also gives an unfair competitive advantage, maybe even to those internationally in the insurance markets, which leads me to my next point with the IAIS, the International Association of Insurance Supervisors. Do you feel the FSB is making enough efforts as an advocate to protect our interest in those negotiations?
I don't think they are, and I think the suggestion that some have offered that our representatives, the U.S. representatives, should not declare any institution systemic until FSOC has already acted, to me is the right approach, rather than trying to back the FSOC into a corner. Let me say, to me, one of the problems is the argument that somehow we need to subject asset managers or insurance companies to bank-like regulation assumes that bank-like regulation works well.
Yeah. Well put. Well put. And it would work well in an industry that is not bank-like. So, Mr. Sawicki, real quickly, since the recession of 2008, have we seen a great deal of capital reformation?
Not that I've seen, but these gentlemen may know better than I.
Could somebody answer that? I mean, have we not seen a greater increase in capital, the formation of capital?
Well, with a zero-interest environment, you would expect it, I think, to...
But have we seen since in the last 5 years any greater access to that capital?
I think, sir, that you're asking a question about whether or not our banking system is doing its job since 2000.
Or our capital markets.
Right. Well, our capital markets and our banking system are somewhat different questions.
But what we're doing is we're seeing more and more private capital being formed, but we're not seeing access to that capital being allowed to the consumers as a result of Dodd-Frank.
Well, essentially, no, I think you're pointing to the wrong cause. We didn't restructure our banks, so our banks didn't do their job.
The gentleman's time has expired.
Thank you.
With that, the Chair recognizes the gentleman from California, Mr. Sherman, for 5 minutes.
Thank you. I'm one of those that was here when Dodd-Frank was written. I'm here to report that it was written in this room, not on Mount Sinai, nor was it written by Beelzebub in the nether regions. It is not sacrosanct, but that does not mean it should be discarded. We need to improve it, not dismantle it. And in spite of its great length, it lacks a whole lot of specificity. It gives tremendous power to the regulators. And God forbid if we get an administration of the other party, we will see just how much discretion it is. A well-drafted statute means the same thing whether you elected a Democrat to administer the law or a Republican to administer the law. I think if we ever get a Republican administration, heaven forbid, we'll find out how much latitude there is in that statute and how Congress should have been more specific. As to SIFIs, I join with the gentleman from Florida, who should be praised at length, except he's not here anymore, about designating money in mutual fund managers as SIFIs. As I've bored some of my colleagues with before, Lehman Brothers didn't cause a problem because it had too many assets. If you're trying to determine whether an entity is a problem, you say, what are its liabilities? Who loses if it doesn't pay its debts? And a mutual fund doesn't have any debts in almost every case. So the idea that we would designate mutual funds as SIFIs because Countrywide made bad mortgages it seems rather extreme. Mr. Akins, I want to focus with you on these credit rating agencies. You put forward the idea that the fault is the people who pay attention to the credit rating agencies, who rely on the credit rating agencies. Let's say you're an ordinary consumer, you got $50,000 to invest, and you're trying to compare the Vanguard bond fund with the T. Rowe Price bond fund. And they both have the exact same portfolio in ratings. 20% AAA, 30% AA, 40%, exactly the same. And one is yielding 10 basis points more than the other. How would you, knowing that you have $50,000 to invest, which means you can't hire Deloitte and Touche to give you a report, how would you decide to forego the extra 1% of return when you see the only way you have of evaluating those two bond portfolios is how the individual bonds are rated by the credit rating agencies? How would you take your own advice and not rely too much on the credit rating agencies?
Well, well, you make a good point, but what I was trying to refer to before was to government regulators who actually, should have known better, and to the SEC. Well,
I don't think. I mean, we all should have known better when they gave AAA to Alt-A, when they gave the highest rating to liars loans. But how are they ever going to stop doing that when they are selected and paid by the issuer? We dealt with that in the Frank and Sherman amendment to Dodd-Frank, but it went into conference. It got diluted just enough so the SEC could wiggle its way around it and issue a report saying they don't want to do anything. And so now we have pretty much the same system we had before. That is to say, you can make $1 million by giving somebody a good grade, and if you give them a good grade, somebody else will hire you to give them a good grade. I don't think that it'll be mortgage debt that causes the next crisis, or at least not in the next few years, because we have some sort of memory, slightly longer than goldfish, and we won't let that mistake happen right away. But whether it's corporate bonds, whether it's sovereign debt, there are so many opportunities people have. Put together a package of debt, buy a good rating, sell it, and then you as an investor almost have to buy it. And the money, and imagine yourself working for T. Rowe Price or working for Vanguard. Would you put together the bond portfolio that had 10 basis points less yield but had the same ratings as your competitor, knowing that you as the investor would choose not to invest in your fund? I would say the credit rating agencies cannot be ignored. They're not ignored by investors. They cannot be ignored by money managers. And as long as they are selected by the issuer, we're just waiting for the next crisis. I yield back.
The gentleman's time has expired. With that, the Chair recognizes the gentleman from North Carolina, Mr. Pittenger, for 5 minutes.
Thank you, Mr. Chairman. I would like to respond to Mr. Capuano's references earlier. He was lauding the merits of the Dodd-Frank Act and the attributes of it and what it had done in behalf of our economy and our housing market. I'm from Charlotte. Charlotte is one of the better economic regions of the country. According to Metro Study, which is a nationwide data company, in 2006, we had 24,000 415 housing starts. In 2014, we had 9,238 housing starts. We're up, 40%, where we were. And I think stats are relative. You can convey a stat in whatever way that you want to make them sound good. And I would compliment Representative Cleaver that we need the facts. And those are the facts. So I think while I appreciate the enthusiasm always of Mr. Capuano, I think we need to be clear that we have not seen the return in the market, in the housing market, of which my former company was involved in for 25 years throughout the country. Access to capital is critical. It's not there. The impediments in getting that capital are clear. These developers have to go outside. They have to go to private equity and other firms that are much more costly. So for clarification, I felt that was prudent. Dr. Calabria, as you know, the insurance companies are under extensive supervision by the states. State laws and regulations are designed to do three things. First, to stop serious financial distress at an insurance company from ever developing. Redress material financial distress when it occurs, and limit the scope and impact of a stress event by facilitating interstate coordination and remedial action. Do you believe that there exist gaps in regulation of insurers that have made FSOC designation of insurers necessary?
I do not.
Well, if no gaps exist, why do you believe FSOC has moved forward with the designations of insurers?
What I would submit, and this has been a fairly consistent theme under both Republican and Democrat treasuries, is there's long been a suspicion of the state insurance regulatory system. One of the few things that, for instance, Treasury Secretary Paulson did before the crisis was issue a report saying how bad the state insurance system was. And so Treasury's long had this viewpoint of we need to get rid of state regulation of insurance. I don't think they've been shy about it, and I think FSOC is largely followed. Let me also echo, you raised a very important point in regard to Congressman Capuano's points, which of course is what we should be doing is comparing this recovery to previous recoveries. The argument that if we had not done Dodd-Frank or the stimulus or this and that we would have been stuck in a hole and people would have stopped going to work and living in caves or whatever, that's not the case. Economies recover.
Thank you. Are you concerned that firm-specific non-bank designations of insurance companies could create competitive imbalances in the insurance market?
Yeah, as I mentioned in my earlier remarks about, to me, I worry that the designation will encourage insurance companies to look more like banks. And in my opinion, the largest insurers are far more better capitalized and far better shape than the typical larger bank. So I don't want MetLife to look like Citi. I think that would be a gross mistake.
Professor Zwicky, do you have a comment on that?
I don't have anything more to add than what Mark said.
Very good. Mr. Atkins?
Yeah, well, I agree with that, and I think you have to look no farther than the President's own appointed insurance expert on the FSOC, who completely slammed, not only in really harsh terms, frankly, not only the designation of Pru, but also the designation of MetLife as being, he said it was unfounded, basically.
Thank you. I yield back.
The gentleman yields back. Just to let our members know, there has been a motion to adjourn vote called. It's a 15-minute vote. So with that, we are going to continue with some questioning here, but if it is all right with our panel, I believe we would shortly take a break to go vote and then reconvene. So with that, the chair recognizes Mr. Ellison of Minnesota for 5 minutes.
I want to thank the chair and ranking member and also the panel. Mr. Silver, one of the requirements of Dodd-Frank was publicizing the ratio of CEO pay to median worker for publicly traded firms. I just want to point out that back in 1980, when I was a sophomore in high school, the ratio was about 42 to 1. In 2014, CEOs receive about $300 and 73 times the average employee. I guess my question to you is, why is this important knowledge for investors? And how does this knowledge further our discussion of addressing economic stability and even equity?
What that information is about, obviously, is internal equity within the firm. And there is a substantial body of research, most recently developed in focusing on retail stores, that suggests that there's a correlation between essentially internal equity within the firm and long-term firm performance. Contrary to what my colleague on the panel, Mr. Atkins, suggests, the securities laws from their very inception were designed to ensure that the public had material information about the management of public corporations. It's very clear the public would very much like to know this, what this ratio is, and know it accurately for all public companies. But the more fundamental question is, it's the law of the land. This Congress passed that statute, and the public's entitled to have it enforced, which it hasn't been so far. In terms of the larger issue of economic stability, underneath the economic crisis of 2000 that began in 2007 was a generation of wage stagnation. It created the political and economic circumstances in which a wide variety of people in both parties were tempted to substitute credit for wages. I think if you listen closely to my colleague Professor Zwickie's testimony, he's in favor of that kind of substitution. I'm not. I think that substitution profoundly destabilized our economy and threatened not just our long-term prosperity, but it threatens us with repeated and increasing severity of financial crises. The pay ratio rule is designed to put valuable information in the hands of both investors and the public that is relevant to that problem.
You know, Mr. Silver, I just also want to ask for unanimous consent to introduce into the record an article from Forbes dated June 16, 2014, which says the highest paid CEOs are the worst performers.
Without objections.
Yeah, so there you go. I'd also like to point out, just for the record too, that the reality about mortgage loans made during the financial crisis and prior to it, about 66% of the loans were equity stripping refinances. And these were cash out refinancing of homeowners with substantial equity, too often loans with predatory terms. I just want to point that out as well. And Mr. Zwicky, I wonder if I could ask you a question, sir. In your testimony, you complain or you point out that the CFPB is engaged in massive data mining program. You say it collects data from hundreds of millions of consumers and credit records, which, quote, far exceed any reasonable regulatory purpose, unquote. And then you cite Mr. Newt Gingrich in a footnote to support your claim. Are you aware that Mr. Gingrich is on retainer from the U.S. Consumer Coalition?
I cited that because
Are you
it was
aware?
no, I wasn't aware. But
Are you aware that that's a 501c4 organization which, according to its founder, Brian Wise, is dedicated to trying to undermine the CFPB? Did you know that?
I'm not aware of that.
I just want to know. So you cited a source and you don't know the terms upon which that citation was made?
I do know the terms because I know those data are accurate because I've seen similar numbers elsewhere, and I just cited that as the most immediate cited.
You cited Gingrich. You didn't mention that he was paid by the U.S. Consumer Coalition, did you?
No,
Did you
I
mention
didn't
he
know
was
that.
compensated? He was compensated for his advocacy? No, you didn't mention that.
No, but the data's out there, and
Yeah.
the data has been reported elsewhere. That was just
So
the
a
most recent
compensated source to advocate a particular line of argument, you don't think it was worth the public's time to know that? No, you don't. Okay, my time's over. Thank you.
Gentleman's time has
No
expired.
further questions for this witness.
Gentleman's time has expired. With that, we are going to go to our last questioner before we take a brief recess. The Chair recognizes Mr. Rothfuss of Pennsylvania for 5 minutes.
Thank you, Mr.
And we won't start the clock yet, but just so everybody's clear, the game plan will be that we will recess briefly, get there to vote, and return immediately back and continue with the hearing. So thank you. With that, Mr. Rothfuss.
Thank you, Mr. Chairman. Thank you, our panel, for being here this afternoon. It's always good to take stock on anniversaries. So we're at 5 years now for Dodd-Frank. I'd like to go back, though, 7 years before Dodd-Frank, just to set the record straight. We've heard a lot about Fannie and Freddie. I want to remind people what was going on in the early 2000s, an attempt to reform what was going on at Fannie and Freddie. Indeed, this committee held a hearing on September 25th, 2003, on whether there needed to be some reforms with the way things were being done at Fannie and Freddie regarding these entities, and its regulator, Barney Frank, made a number of really striking statements, including this one. I do think I do not want the same kind of focus on safety and soundness that we have in the Office of Comptroller of the Currency or Office of Thrift Supervision for the Fannie and Freddie regulator. I want to roll the dice a little bit more on this situation toward subsidized housing. Dr. Calabria, any reaction to rolling the dice?
Well, I guess first of all, I would note that the OCC was the primary regulator of Citibank, so even OCC level regulation apparently wasn't very good. But that said, let me, if I can, and certainly not personal pushback a little bit. Lots of people across the aisle were wrong on Fannie and Freddie, and so I do think that that's worth remembering. I think if we could put aside,
But they're wrong on Fannie and Freddie.
They are wrong on Fannie and Freddie. A number of people were.
And it was a big contributing factor to what we saw with Dodd-Frank. I want to talk a little bit about Dodd-Frank and how it was marketed as a way to end too big to fail. Prior to its passage, then Secretary Geithner claimed the law would end too big to fail. And at the signing ceremony for the Dodd-Frank Act, President Obama proclaimed the following: after taking office, I proposed a set of reforms to empower consumers and investors, to bring the shadowy deals that caused this crisis into the light of day, and to put a stop to taxpayer bailouts once and for all. Today, those reforms will become the law of the land. Of course, we know that Secretary Geithner backtracked from his suggestion that this would end too big to fail, and in 2014, the question came up, and he said, of course it didn't end too big to fail. Dr. Calabria, I'd like to go through the list that the President talked about and get your thoughts on whether the reforms that the President claimed have in fact been achieved. Specifically, has Dodd-Frank empowered consumers and investors, or has it resulted in fewer and more expensive choices for consumers and reduced upward mobility, particularly for those economically disadvantaged groups that have historically had the most difficulty accessing credit?
Well, I think the numbers are fairly obvious that it has been a burden in that regard.
Has Dodd-Frank eliminated shadowy lenders, or has the avalanche of regulations that it imposed on our financial institutions actually led consumers to less regulated areas?
That certainly seems to be the case.
And finally, did Dodd-Frank put an end to taxpayer bailouts once and for all, or did it rather enshrine too big to fail into law, resulting in an expansion of the federal safety net and increasing the probability of future crises and bailouts?
So to again clarify my earlier statements, I do believe that Dodd-Frank offers a path to ending bailouts. I just don't, but it's an optional path, and I think it's highly unlikely that regulators will ever choose it. And one of the reasons I believe so is because those similar powers are put in place for Fannie and Freddie, and they were not used at that time. So as long as we have the Tim Geithners or the Hank Paulsons at the seat, to me, I think you should bet your money on that the creditors are going to get bailed out.
Professor Zwicky, earlier this week, the IMF released its annual review of the U.S. economy. The report found that some key vulnerabilities in the U.S. financial system have yet to be addressed, notably the housing finance system. The IMF also found that the Federal Reserve's extraordinarily loose monetary policy and low interest rates have encouraged firms to take on additional risks in search of better returns. Finally, the report expressed concern about consolidation within the banking sector, particularly that large and interconnected banks dominate the system even more than before. I find this report to be particularly troubling given that it was bad government housing policy and Fed monetary policy that helped set off the last financial crisis. Furthermore, there is much evidence out there to show that Dodd-Frank regulations and SIFI designation process is actually encouraging additional consolidation rather than eliminating it. What do you say to these concerns and those identified by the IMF?
I agree with all of that, which is big banks are getting bigger, smaller banks are getting crushed. We've done nothing to deal with the incentives that consumers have to walk away from homes that are underwater, such as requiring higher down payments, dealing with state anti-deficiency laws. And we're seeing exactly the same phenomenon that we saw earlier, and I don't want to overlook something that Dr. Calabria mentioned earlier, which is the fuel that drove this fire was the Federal Reserve's crazy monetary policy from 2001 to 2004 and thereabouts, and we're doing exactly the same thing now, and we're inflating another bubble probably in the housing market in a lot of areas.
Thank you, Mr. Chairman. I yield back.
The gentleman yields back. Just so everybody is aware, we have 2 minutes and 40 seconds left in this 15-minute vote, and so we will recess at this time until immediately after votes, where we will return. So, thank you.
The committee will come to order. Chair now recognizes the gentleman from Connecticut, Mr. Himes, for 5 minutes.
Thank you, Mr. Chairman, and thank you to the panel. I really appreciate this opportunity to reflect after 5 years on the effectiveness of Dodd-Frank. I was here when it was put together and participated in the many discussions around its creation. And I remember the extravagant, not to say apocalyptic warnings about how this was going to be what everything else the Democrats proposed at the time, a job-killing bill, that it would represent what has generated some echoes here today, a lack of freedom for consumers, and all sorts of other things. And of course, and this caught my attention, it was to devastate, and again, the language was beyond apocalyptic, it was to devastate a key American competitive advantage, our capital markets. A lot of that criticism has begun to fade such that we hear echoes of it today. It's hard to call all that stuff job killing when you've been through 12 million new jobs created and on average 250,000 jobs added per month. It takes some of the sting out of that accusation. The question of the capital markets, though, caught my attention. I have the privilege and sometimes challenge of representing a district which is very, very dense with people who work in the financial services industry, and I'm the first to recognize that there was both individual and institutional crazy, if not to say criminal behavior in the industry, but it is also true that these capital markets are essential to Main Street, to borrowing for mortgages and student loans and consumer lending, and of course for our businesses. So I thought I might just take a look at the facts around what has occurred in the capital markets in these last 5 years and just put together some facts which are displayed there, and I'd ask the Chairman for unanimous consent to make this part of the record.
Without objection.
Businesses and people borrow and access capital. Upper left there, you see the commercial and industrial loans since Dodd-Frank, a very strong rise, up 60%. Small businesses access venture capital. In the upper right, you see venture capital investments up over 100%. People and companies benefit from the stock market. Lower left, you see the behavior of the Standard & Poor's 500, up almost 100% in the 5 years since Dodd-Frank. That's a pretty darn nice return for some people who got badly hurt in the crisis, and of course represents, if nothing else, a real vote of confidence for those capital markets that we were promised would be devastated by Dodd-Frank. Lower right, what about people? Consumer credit. Again, we've been hearing a lot today about a reduction in freedom in terms of the products that are available to consumers. The graph in the lower right would suggest that even if there is a reduction in freedom and a reduction in choices, there has certainly not been reduced consumption of consumer credit. So I think it's fair to say that the facts demonstrate that Dodd-Frank, far from having a catastrophic effect on the capital markets, actually contributed to the restoration of those markets in something that we consider a key competitive advantage. We now hear the criticisms reduced to the abstract and academic notion that, gosh, things could have been better. If only others had been in charge, we would have had a more robust economy, or perhaps those charts, which are pretty dramatically in their northeasterly direction, would be somehow more northerly in their direction. But those facts are important. And they're important because we see efforts to eliminate an awful lot of the protections of Dodd-Frank, which I would argue would perhaps turn those graphs around. I did want to make that point and that reflection at this 5-year anniversary, but I do have a question. Again, representing as I do a district for whom the financial markets are pretty important, I have always recognized that while a very important and good step forward, Dodd-Frank is far from perfect, and there are, in fact, changes that should be made. So in the very limited time I have left, I would just love to get from each of you very quickly, if you could make one change, the change that would draw agreement on the part of peer-reviewed academics and others, if you could make one change to Dodd-Frank, what would it be? Let me just quickly go from left to right.
Well, it's hard to pick out of all 15 titles, but I'd start with Title I for sure, and address the potential of the FSOC and the Fed bringing in bank regulation to the
Thank you, Mr. Calabria.
Reiterate, a lot to choose from, but if you want to talk where there's most robust agreement, I think most of the academic literature does suggest that Title I of designating entities sends the wrong signal to the marketplace.
Thank you. Mr. Silvers?
I would restore Glass-Steagall.
Restore Glass-Steagall, meaning force a separation of commercial banking activity from brokerage activity.
And obviously, I wouldn't literally take the words of Glass-Steagall. I would try to enforce that concept in modern context.
Thank you. Thank you, Mr. Zucchi.
I would make the CFPB into a bipartisan commission and put it on budget and remove its role in safety and soundness checks.
Okay, so 2 Title Is, 1 CFB, and Glass-Steagall. Thank you. I appreciate it. Thank you, Mr. Chairman.
Time of the gentleman has expired. The chair now recognizes the gentleman from Indiana, Mr. Messer.
Thank you, Mr. Chairman. Would like to start with Mr. Calabria. Would talk a little bit about some of the unintended consequences of Dodd-Frank. As you heard from our colleagues on the other side of the aisle today, apologists for Dodd-Frank are fond of saying that the law struck a direct blow against Wall Street, remade the financial system so that those firms are no longer enjoy the privileges that made them too big to fail and gave rise to the taxpayer bailouts of 2008 and 2009. In reality, though, the biggest Wall Street firms are the beneficiaries, not the victims of Dodd-Frank, both because the law cements them as too big to fail and because the massive regulatory dragnet it casts over the financial system makes it difficult for smaller firms to compete. There's no mystery to this. Goldman Sachs CEO Lloyd Blankfein, J.P. Morgan Chase CEO James Dimon have both said that Dodd-Frank gives them some competitive advantages because of the broad scope of regulatory costs associated with the law. Harvard University released a study recently that confirms this. And just anecdotally, we all know, you can count on the fingers of one hand the numbers of new banks that have been chartered since Dodd-Frank was enacted. So, Mr. Calabria, who should we believe? Our colleagues on the other side of the aisle and the Obama administration who loudly proclaim Dodd-Frank administers harsh medicine to Wall Street, or the CEOs of those same firms who tell us they're actually the competitive beneficiaries of this law?
Yeah, certainly I think the evidence is pretty overwhelming that concentration has increased since both the crisis and since Dodd-Frank. I'd be the first to say lots of causes go in there, just as there are lots of causes with the market going up. You know, I would, for instance, suggest that maybe 6 years of negative real short-term rates might have actually inflated the equity markets a little bit, and we'll see what happens when those things turn around. But I think absolutely there's no doubt in my mind that you've seen growing concentration both on the commercial banker side and on the broker-dealer side.
You're nodding.
I agree completely, which is we've known for decades that regulatory structures fall harder on small businesses. What we've done is created this this huge regulatory structure that imposed it on community banks, who obviously didn't cause the problem here. And just the regulatory compliance cost is just killing these businesses, not to mention, as I said, on products such as mortgages, it's gotten rid of their competitive advantage, which is relationship lending and knowing about their customers. And so it's absolutely, in my view, accelerated consolidation of the financial industry and further destabilized the financial system.
Thanks. Real quick to Mr. Atkins, we'd like to raise with you an issue that's actually beyond the scope of Dodd-Frank and deals with the liquidity coverage ratios under Basel III. And it came to my attention, and you're probably well aware, the federal banking regulators have excluded all American municipal bonds from being treated as highly liquid assets under the LCR rule. Creates a remarkable situation where certain German bonds qualify as these sorts of assets when most American municipal bonds don't, where all American municipal bonds don't. It obviously disincentivizes banks from investing in those assets and potentially raises borrowing costs. We all know that outside of U.S. Treasuries, American municipal bonds, our securities, are some of the safest investments available, with state and local governments having about a 0 default rate. To help ensure that we change that, I've authored with Congresswoman Maloney from New York legislation that would essentially direct the FDIC, the Federal Reserve, and the OCC to classify investment-grade American municipal bonds as level 2A securities and highly liquid assets. Just everyone that I've talked to tells me that these investments are some of the safest in the world. Can you help me understand why it would make sense to allow German bonds to qualify as that kind of asset and not allow American municipal bonds?
Yeah, well, the problem with Basel's 1, 2, and 3 basically is that they categorize these various investments in buckets, and there's always an incentive then to choose the riskiest, therefore the highest yielding ones in each of those buckets, and not to have a real market-based type of evaluation to it. So it's really the regulators, choosing winners and losers, if you will. So I think there's a fundamental flaw in all of that design.
And let me just ask this simple question. Do you think if a bank needed to sell investment-grade municipal bonds, they could do that? Could they find buyers if we were at a time of financial stress?
For a bank to,
Yeah.
yes, I would think so.
They'd be liquid.
So.
Thank you.
Time of the gentleman has expired. The chair now recognizes the gentleman from Texas, Mr. Green, ranking member of our Oversight Investigation Subcommittee.
Thank you, Mr. Chairman, and I thank you for your service on this committee as well. It is my understanding that some of the members today have opened the door to talking about invidious discrimination. And while we're talking about Dodd-Frank, I think that it is appropriate that we mention some aspects of invidious discrimination, because there are some things that Dodd-Frank does not do to the extent that I think that it should. So I agree with those who contend that Dodd-Frank is an imperfect piece of legislation. So let's just talk about some of the things that I would like to see us impact by way of the work of the committee. I have a statement here indicating that minority owners, these are business owners, minority business owners paid interest rates that were 32% higher than what whites paid for loans in 2012. This is by way of the Federal Reserve, by the way. This is what the Fed says. Dodd-Frank doesn't do enough to address this kind of invidious discrimination. Pleased that someone brought it up today. Otherwise, I might not have put this in the record. Wall Street Journal. In 2013, only 4.8% of loans made to buy homes were made to blacks. However, blacks comprised 13.2% of the total population in 2013. Now, I know that we can rationalize that and say, blacks don't make as much, they probably don't have the credit history, all kinds of ways to rationalize it. But one of the best things that we can do is investigate and find out why blacks are at this number. In 2013, only 7.3% of loans made to buy homes were made to Latinos. However, Latinos comprised 17.15% of the total population in 2013. Dodd-Frank doesn't do enough to help us. Hope that the committee will. According to CNN, 2013, HMDA data, the conventional mortgage loan denial rate was 10.4% for whites. By comparison, however, the denial rate stood at 27.6% for blacks, 21.9% for Hispanics, 13.3% for Asians. The information goes on and on and on, but I'll move now to the Washington Post. Between 2004 and 2008, black borrowers were 54% more likely to have a high interest rate mortgage. Black borrowers. Latino borrowers, 45% more likely to have a high interest rate than similar white borrowers, I might add. Asian American borrowers, 7% more likely. Now, these are things that we can investigate, things that I think the committee should investigate. I think that on the heels of what we've just seen in South Carolina, where we're eliminating symbolism, seems to me that we have an opportunity to actually get into the invidious discrimination that still takes place. And my hope is that we will look into these things at the committee level. We're currently examining the CFPB. And of course, until 1968, we were known as the Banking Committee. These lenders, they bear a look being taken at them. My hope is that we'll do it because we tell people to pull themselves up by their bootstraps. These loans, these mortgages are bootstraps. My last 9 seconds, I appeal to the committee to please, it's an appeal. Let's look into this. I thank you, Mr. Chairman. I yield back.
Time of the gentleman has expired. The chair now recognizes the gentleman from Colorado, Mr. Tipton.
Thank you, Mr. Chairman. Appreciate the panel's time for being able to be here. As we listen to our colleagues' comments from the other side of the aisle, they want to be able to interpret that Dodd-Frank has helped bring the economy back. I think it is worthy of note. We have the lowest labor participation rate in 4 decades. For the first time, I think you'd mentioned this, the Brookings Institution report coming out saying we have more small businesses shutting down than there are new business startups in this country. We're suffering under $2 trillion worth of regulatory costs, which is driving up costs if you care about people that are on fixed incomes, young families that are trying to be able to get a start, increasing their costs by inhibiting their ability to have access to capital. We've talked about Dodd-Frank today and too big to fail. Unfortunately, it's become apparent that both anecdotally and empirically that the legislation has failed to be able to live up to its goals. Banks in my district and across the country have told me time and again that compliance costs brought on by one-size-fits-all regulatory schemes have made it impossible for them to be able to lend to credit-worthy Main Street businesses. Instead of working with the community, small banks and credit unions are working to comply with rules and regulations that were intended to curb Wall Street banks. Delta Bank in Delta, Colorado told me that they don't know how much longer they're going to do it because they feel that they are no longer working as a bank, they're working for the federal government and for regulators. Large banks do have the economy of scale to be able to deal with additional compliance costs while smaller banks simply cannot compete. Instead of promoting healthy growth in the financial system, the rate of decline in community banks' market share has doubled since Dodd-Frank was enacted. For this reason, I introduced the Taylor Act of 2015, legislation that directs federal regulators to consider the risk profile business model of an institution while promulgating regulations. Regulations will be tailored in order to be able to limit compliance costs when the regulation is considered not necessary or appropriate for the institution. This piece of legislation, which has the support of over 55 state banking and credit union associations, is a crucial step toward limiting the regulatory burden for those banks and credit unions that are struggling to be able to operate in our Main Street communities because of the burdens placed on them by Dodd-Frank. Mr. Zawecki, you'd commented several times during your testimony about the destruction of the relationship between community banks and the customers that they were designed to serve. Can community banks survive in this new regulatory framework if they can no longer rely on that traditional banking relationship?
It's hard to see how, and it isn't just that they're exiting the mortgage market. As I said, 64% of community banks said they've changed their mortgages because of Dodd-Frank. 15% said they've completely exited or considering exiting the market, and 70+% have said that the cost and everything has changed the way that they do business. I don't see how in the current regime they can possibly survive under that sort of regime. And I think it was perfectly summarized by the bank you referenced, which is their customer now is the federal government, not their customers. They are looking over their shoulder constantly rather than looking at the person across the desk from them, and I think that is terrible. I'll add one other thing. It's not just mortgages. It's also, according to the Kennedy study, agriculture loans. These big banks aren't going on the rural communities and making agriculture loans and that sort of thing. These community banks serve an important function in the American banking ecosystem. A lot of consumers prefer it, and I think it's a shame that they're being competed out of the market, not because they can't, because they just aren't allowed to compete on a fair footing because of the regulatory cost.
You know, you just spoke to two things that are near and dear to my heart. I represent a rural district in Colorado, agricultural interests and small businesses. Are we inherently seeing, because of Dodd-Frank, small businesses, small banks literally now being almost forced into a position to where they're going to have to be able to merge, be bought up by a larger institution, and the impacts that that is obviously going to have in terms of that relationship?
That's obviously what we're seeing, is that they're being forced to, they're either disappearing or being forced to merge, and it's an unbelievably ironic consequence of Dodd-Frank that the big banks are getting bigger, that we're getting more consolidation in the banking system, when the whole idea was to get rid of too big to fail. The big banks are getting bigger.
And so we're just codifying too big to fail as we continue to pursue an overzealous regulatory regime that's impacting us at the local level. You know, I think it's important. Oftentimes we talk about the rules, the regulations, the laws that are passed, but what you're speaking to is something that I believe we need to be focusing on. These are the people at home. The Hopscotch Bakery in Pueblo, Colorado. Very small bakery. She came to me and she said the big issue for her was access to capital with a local community bank who wanted to be able to make the loan, but regulatorily was not going to be able to make that loan. Do we need to focus more on the outcome of the law and how it's impacting Americans?
Absolutely, and we hear those stories from all over the country.
Thank you.
Time of the gentleman has expired. The chair now recognizes the gentleman from Texas, Mr. Williams.
Thank you, Mr. Chairman, for holding this hearing today, and I want to thank all of you for being here. I wanted to switch gears a little bit and discuss how the CFPB under Dodd-Frank has continued to expand its influence into areas it has no authority under, something even Director Cordray told me himself that the law doesn't address. Of course, I'm talking about the auto industry. I'm a car dealer. I'm one of them, okay? So my question for you, Mr. Zawicki, is I'd like to ask you about the CFPB's settlement with Ally Financial, in which CFPB got Ally to pay $98 million by accusing the company of discrimination against car buyers based on desperate impact statistics. I've said this in previous hearings, but I think it's worth repeating today. As a car dealer myself, the idea that I would charge different prices to my customers based on race, religion, or the color of one's skin is offensive not only to me, but my industry. In fact, if I was doing that, I don't think I'd be very successful. So it has been a year and a half since the Ally settlement. Do you know if the CFPB has paid any of the $98 million to consumers who the CFPB said were discriminated against?
Thank you, Congressman Williams, because I think this example of what they're doing with the auto dealers is one of the most egregious examples of regulatory empire building I've ever seen. Dodd-Frank makes it very clear that they can't regulate auto dealers, and so instead what they've done is essentially strong-armed indirect auto lenders and essentially forced them to become arms of the federal government to enforce this agenda. What is this agenda? It's an agenda that's been written about extensively, which is sort of disparate impact on steroids. There's an amazing study at the American Financial Services Association published by Marsha Korchain, which uses this Bayesian, whatever the term is, to try to identify the so-called plaintiffs, and it's a joke. It has no verifiability in doing it. They finally entered into this settlement for Ally under who knows what conditions, and they don't have any they don't actually have any victims. They've got statistical victims. They've created this claim form that seems to be completely on the honor system, where people don't have to prove they were overcharged. They don't have to prove anything. They can just write in and get some money. And so maybe the CFPB is going to distribute money to people, but there's no indication that they're distributing them to actual victims of discriminatory practices.
Well, with that being said, in fact, I had my staff pull up the form. This is it right here, that they would have discriminated buyers fill out. In my opinion, it's ripe for fraud. You've agreed with me. If you look at this form, it basically says if you took out a loan that Ally later financed in a certain period of time, the CFPB will assume you were discriminated against. Well, I'm in the business, but I have bought 2 cars and financed them through Ally, so I wonder if I should fill this form out and send it in. Now, Mr. Zawicki, in the interest of time, just a quick yes or no answer to the following question, if you don't mind. Do you think the process the CFPB set up that we're talking about is designed to determine whether...
I'm sorry, would the gentleman suspend and hold the clock? Apparently we have a one vote on the floor, and I might suggest that, that the gentleman from South Carolina, have you voted on this? Perhaps we can avoid a recess if the gentleman from South Carolina and the gentleman from And the gentleman from Maine would quickly go vote and return back to the committee room. Perhaps we can avoid a recess here. I thank the gentleman for yielding. We yield back to the gentleman from Texas.
Thank you, Mr. Chairman. Do you think the process that we talked about is designed to determine whether borrowers were actually discriminated against?
No, I don't see that.
And what about the CFPB restitution form we just mentioned? Do you think it prevents fraud?
No, I don't see any indication it does.
And do you see anything that would indicate that the CFPB is even asking whether borrowers paid a higher interest rate than other loans?
I don't see that on the
Not on there. Mr. Calabria, for you, under section of 1022 of Dodd-Frank, the CFPB was given a broad authority to exempt financial services providers from its rules based on asset size, volume, etc. As you know, the CFPB has used this authority sparingly, often creating an exemption so small it doesn't actually help those credit unions or community banks that are hurting because of over-regulation. I'm saying this real quick because I'm working on a proposal that would exempt community banks and credit unions under $10 billion in assets from CFPB rules going forward. Effectively, it turns the exemption on its head and forces CFPB to consider the impact on smaller financial institutions and make an affirmative finding that community banks and credit unions are indeed the intended targets of these rules. So my question to you is this: do you think Section 1022B of the law is clear?
Absolutely. Yes.
Thank you. And shouldn't the CFPB be doing analysis and affirm that smaller financial institutions actually need or don't need to be included in the rules they are writing?
Yes, I think they would be better allocating their resources on larger entities.
Mr. Chairman, I yield back. Thank you very much.
I'm sorry the gentleman yielded back, since we're trying to give a little time here before the other gentleman returned from the House floor. At this time, we yield to the gentleman from Kentucky, Mr. Barr, who I trust will take his full 5 minutes.
Yes, Mr. Chairman, and I'd be happy to take even more with this great panel, but I appreciate the recognition, and I thank the panel for your testimony. This has been a fascinating hearing as we examine the impact of the Dodd-Frank law 5 years since its enactment. And let me start with Professor Zawicki. I'm particularly concerned about the impact that the Consumer Financial Protection Bureau is having on access to consumer credit for many of my constituents in central and eastern Kentucky. And I, too, have heard the unfortunate stories of credit-worthy borrowers who are no longer able to access a mortgage or get a credit card or an auto loan or maybe short-term credit. The example that you gave about the gentleman who needs a $500 transmission change just to get to work, but no longer has access to short-term credit or payday loan, really does have a negative impact, not just on the broader economy, but on these families. And it's really sad. But let me ask you about a follow-up to Chairman Nagelbauer's proposal, which was a proposal to reform the Bureau to a commission structure, a bipartisan commission structure. I also have a reform bill called the TABS Act, Taking Account of Bureaucrats Spending Act. This would place the Bureau under the appropriations process, like many other regulators in the federal government. What impact would that have in terms of effectuating the Congress's power of the purse and holding the Bureau accountable?
I think that would definitely increase the responsiveness and the ability of the CFPB to do its job, which is too much independence, just bureaucrats left to their own devices do their thing, right? What we've learned over time is that checks and balances actually work, that Congress's role in being able to control the power of the purse and actually supervise with some strength over executive agencies makes the agencies better.
Now let me ask you,
consumers
let me ask you a little out of the box question, because we have these reform ideas that are actually consistent with the original design of the Bureau. But I was interested in your testimony and your former service at the Federal Trade Commission and its focus on the mission of promoting competition and choice as a core of consumer protection. So my question to you is, would it be something that you would entertain as a positive idea to actually fold into the mission of the Federal Trade Commission the functions of the Bureau if the Bureau continues to fail the American people?
I agree completely, which is, I actually agree with the idea of having one agency that would regulate consumer credit. I don't think the old system did work. I thought we could have just given it to the FTC. If we don't, we should model it after the FTC, and I've written a long law review article where I urge exactly what you're suggesting, Congressman Barr, which is combining a mission of competition and consumer protection and understand that consumers benefit not just from consumer protection narrowly defined, but also from innovation, competition, choice, lower prices, and all those sorts of things.
I want to read your law review article because I totally agree that competition, choice, and innovation is the best consumer protection. Let me turn to Mr. Atkins, and I appreciate your service and your expertise. Secretary Lew testified in front of this committee a few weeks ago, and we talked about changes in the capital markets after Dodd-Frank, some of the illiquidity that we're seeing in the fixed income markets as a result of Volcker in particular, and I appreciated your testimony about the concerns you have with Volcker, especially since proprietary trading really wasn't the cause of the financial crisis. My question to you is, when Secretary Lew responded to, was asked about illiquidity, he disclaimed responsibility from regulations in Volcker, and his answer was that he thought changes in market structure were to blame for the liquidity problems. Dr. Calabria, I think you mentioned that there could be some changes in fixed income market structure, and he also mentioned high-frequency trading. My question to you is, could you comment on Secretary Lew's refusal to assign any blame whatsoever to Volcker and other regulatory pressures?
Well, I don't know exactly what he said then, but to ascribe everything to market structure changes, or some people have said increased transparency in the market has led to that. I think that's not accurate. I think you have to lay the blame at the Volcker rule because basically you have to have people trading in the markets to set prices.
Well, as I mentioned, Volcker is forcing banks to divest of AAA paper that hasn't defaulted in 20 years, and there was really not much of a response from the Secretary on that. Finally, let me conclude with Dr. Calabria. We've talked about consolidation and SIFI designation and OLA and this new safety net as contributing as opposed to detracting from too big to fail. Can you comment on what those factors? Is Dodd-Frank the cause of these large 6 mega banks, Wall Street banks, getting bigger? And I understand economies of scale and the need for large institutions to service complex customers, but could you briefly comment on that?
Well, let me say, rather than cause, I think it's best to think about it as a contributor.
A contributor. Yeah, thank you. Yield back.
The chair wishes to inform members that the chair did not know there were 2 votes on the floor as opposed to 1. I'm going to yield to the gentleman from New Hampshire, Mr. Ginta, for 5 minutes, at which point he will recess the hearing until after the completion of the second vote. Again, we appreciate the indulgence and patience of the panel. The chair recognizes the gentleman from New Hampshire.
Thank you, Mr. Chairman, and thank you for your indulgence relative to our voting schedule this afternoon. I first want to thank the panel for being here. It's clear to me, and there's been certainly debate about this, but I have clearly seen the harmful effects of Dodd-Frank and the effects that it's had on community financial institutions, and most importantly, those consumers and users of those products. The Mercatus Center at George Mason University recently released a paper, actually back in February 2014, that shows small banks have eliminated or are planning to discontinue certain products or services as a result of Dodd-Frank. That is indisputable fact. Nearly 64% of the banks surveyed anticipate making changes to the nature or assortment and volume of mortgage products and services as a result of this new regulatory action. The study also showed that roughly 10% anticipate discontinuing residential mortgages due to Dodd-Frank, and approximately 5% have already done so. Residential mortgages or mortgage servicing, home equity lines of credit, and overdraft protection are among the most likely products and services to be cut. In New Hampshire, where I represent, we have about 30 community banks,
that offer a wide array of products and services to Granite Staters. However, due to severe regulations, I continue to hear from my community banks that they've had to limit products. They've had to limit loans and services to my constituents, to their customers and consumers. I personally do not see that as a favorable response to Dodd-Frank. Maybe others disagree. But I wanted to ask Professor Zwicky, would you agree first that consumer choice in products and services is important for overall well-being for consumers, or do you think that more choice in products and services harms those very consumers? Very simple and straightforward question.
I think American families are a much better judge of what financial products are appropriate for their lives than Washington bureaucrats. And I think that consumers unquestionably benefit when they get to choose the institution and the products that they think will make them better off.
And do you think that Dodd-Frank regulatory changes negatively affected community financial institutions' ability to offer products or services to consumers more than it has affected larger institutions?
Absolutely. As we've mentioned, we do see community banks shrinking. We see community banks retrenching in the products that they're offering. Some leaving completely leaving very important markets such as mortgages, simply because they can't deal with the regulatory cost associated with Dodd-Frank.
And since Dodd-Frank has been implemented, has consumer choice increased or decreased in products or services?
Consumer choice has unquestionably decreased, and I must disagree with the congressman from Massachusetts, Congressman Capuano, who sort of ridiculed the idea that consumers are now paying, that the consumers have lost access to free checking and paying higher bank fees. We're talking about 1 million people who lost bank accounts because now they have to pay for bank accounts that used to be free. Those are the poorest and most vulnerable Americans who were thrown out of the banking system because they couldn't afford to pay the higher accounts. And whether it's higher rates on credit cards, less access to credit cards, less access to mortgages, less access to home equity loans, across the board, we've seen consumer choice restricted, and prices have gone up, and consumers have been made worse off as a result.
So the gentleman from Massachusetts and I have similar districts in terms of some of the characterizations and categories of people we represent. I'm from Manchester, New Hampshire, our state's largest city. I used to be mayor. 110,000, 115,000 people, average median income, family income, about $54,000. You go to the south end of Manchester and you ask somebody, are they happy by paying $5 to $10 per month for the privilege of banking with their institution that they had banked with for the last 15 years, they would say, arguably, no. But it's not just that issue. And this is where I think we have differences of opinion amongst the panel and the members of this committee. I look at cost of living. I look at the cost of groceries. I look at the cost of home heating oil. I look at the cost to do banking. I add those up, and I look to the people I represent who are struggling in this economy. It was mentioned that there's a 5.3% unemployment rate. That's true. But the average weekly wage in this state, in this country, has not increased dramatically from 2008 to today, and I see my time has expired. I'd like to recognize Mr. Mulvaney for 5 minutes.
Inquiry?
Yes.
Do you want to go vote?
Yes.
Okay. Do you want me to sit over there while you go do that?
I would like you to invite you to sit at the chair.
Okay, because there's a second one coming up, I think. Yes. I'm a lot shorter than Mr. Ginta, so I clearly not going to solve that problem. Gentlemen, thank you very much. I recognize myself for 5 minutes. Thank you for doing this. I know it's been a long day, and I know at least some of you have been here enough to know how this works. But for those of you who have not done it, Mr. Atkins, I don't know how often you've been here before. We mean no disrespect by our coming and going. I can promise you that. And the questions that you get at the end, I hope, are just as important as the questions you get at the beginning, since Mr. Emmer and I are the ones asking them at the end. And I wish Mr. Meeks was here, because he said something earlier today that caught my attention about stability. and about how he was pleased with stability in the financial service market since Dodd-Frank went into place. And that sort of got my attention, because stability can be a really good thing, and then too much stability can be a problem. The banks in Greece today are really, really stable because they're closed. My guess is they won't be nearly as stable next week if they open again. But stability for the sake of stability is not necessarily a good thing, but it is certainly something to pursue. And with that in mind, Dr. Calabria, you and I have talked in the past before about other ways to get to stability. That if the goal of Dodd-Frank was to bring stability to the market, to make sure banks could not fail or weren't too big to fail, or what, all the rhetoric we've heard, there's other ways to do that that might be much, much simpler, and that would be to simply require a higher level of banks to hold a higher level of capital. Would you like to talk about that for a few minutes, sir?
Absolutely. So I think we can have, at the same time, stronger regulation that is simpler regulation, and capital certainly is very much the regard. Earlier, some comments were made about the Basel system of capital. I would actually suggest the U.S. just pull out. I think Basel has been a disaster. The complexity does not work very well. I will note for the committee that, for instance, probably Citibank, the most troubled bank during the crisis, its Tier 1 risk-weighted capital never fell below 8% during the crisis. So that either tells you that either something is wrong with our system of capital, or maybe we didn't need the TARP and all these things anyhow, or both, rather. So I do think we need a simpler system, and I think simpler does not mean weaker. I think simpler could be stronger. And I do think we can get rid of a lot of the unnecessary, costly regulations while actually having regulations that make us stronger.
One of the things I discussed with one of your predecessors at Cato was this concept of this simpler system that will require a much higher level of capital. You could opt in or out. If you wanted to operate as a traditional bank, you wanted to have proprietary trading, you want to do all the things that the Goldman Sachses of the world do, and you want to maintain your 6 or 10% capital, that's fine, and that option might be available to you. But if you wanted to be a community bank, and you didn't want to deal with derivatives and interconnectivity, all you wanted to do was lend money so your people in your neighborhood could buy cars and houses, that maybe there could be a different system that would be set up for you at a higher level of capital. You given any thought as to what that level might be?
So, and again, I would emphasize, to me, I think first of all, it cannot be something that's risk-weighted, because I think that minimizes the transparency. It has to be a pure, simple leverage ratio. I think something in the neighborhood of 15, 17% is something that will get you a tremendous amount of stability. I will emphasize, in my opinion, the trade-off should not simply be you hold 15, 17, and you get out of Dodd-Frank. It needs to be broader than that. I think there are a tremendous amount of costly regulations that predate Dodd-Frank.
But there are certain things that immediately would become surplusage if I had 15% capital, right? Such as what?
Absolutely. So some of the examination process, I mean, certainly you want to make sure the capital is real, but I do think you could give some differences for institutions in terms of safety and soundness prudential regulation, because ultimately what we want to have is that the bank's owners have their money at risk. And I think that's what we want to substitute for.
Fair enough. Mr. Silvers, I'm going to take advantage of the fact that I'm here and nobody else is, which is a lot of fun. What do you think of that? It's probably the first you've heard of it. What are your thoughts? And again, I'm committing a cardinal sin here. I'm asking a question that I don't know the answer to, but I would be curious to know what the Democrat witness thinks of basically that kind of idea. I'm not asking you to support it or oppose it, just curious as to your thoughts.
Congressman Mulvaney, I have heard similar ideas. I haven't heard Dr. Calabria's version. I think that, in general, the basic notion that a straight capital test that is not risk-weighted is a very important and good idea. It's a real problem in the Basel system that they keep going back to risk-weighted capital tests that allow for game playing in various ways, and that when you look at the straight capital test, it's very low.
And for lay people, which includes me, the risk weighting bias might, for example, encourage banks to hold sovereign debt versus corporate. Is that right?
It could encourage any number of things you might not want to encourage.
Gotcha.
Right, and it presumes something that has turned out not to be true over and over again, which is that those particular regulators are good at picking what's risky and what isn't. The question of whether or not you could do that it's a kind of, you've heard me before talk about Glass-Steagall. You're proposing a kind of Glass-Steagall. meaning that you're proposing a different set of regulations and a different set of capital requirements depending on whether banks are active in securities markets, derivatives markets, and various other exotic things. So I'm inherently sympathetic to that. The caveat I would offer to you is this. During the subprime bubble, a lot of the loans that were made were actually not made by the banks that were financing them. They were made by smaller institutions, generally non-banks, that were conduits. The main issue with a different regime for small banks is that question. Are they going to be conduits for big things that are going to move through without reference to capital, and thereby be vehicles for what I would be concerned about is vehicles for exploiting consumers in various ways, as turned out during the subprime crisis. That's the thing you got to watch out for in these types of ideas. The notion that we should have banks that do the business of providing credit to businesses and consumers, and banks that play in secondary markets, and they should have different rules, perhaps different capital requirements, and that it should matter what the size is, I agree with all of that.
That's interesting. I wish you were here yesterday. We just had a hearing on the SIFI designation of bright line rule at $50 billion. It would have been interesting to have that insight.
Well, if you don't mind, I'd be happy to say something about that. A lot of the discussion about SIFIs, it seems to me, you really don't want, you want the ability to look at what firms are actually doing. So that, for example, the discussion that all mutual funds are not systemically significant doesn't match what happened in 2008. It's very clear that money market mutual funds are, right? The same thing is true with insurance companies. If you have a pure life insurance company, the odds that it's going to be systemically significant may not be very great. But on the other hand, if you've got an entity on the side here that's dealing in derivatives very extensively, that's a subsidiary of an insurance holding company, which was AIG, that can be a very, very dangerous thing, as we learned. The 50 billion, in my view, the $50 billion test it's certainly the case that institutions that have more than $50 billion in assets can, depending on what they're doing, could be systemically significant.
But the simple fact that they're $50 billion doesn't make them.
I'm not convinced that's the right number, but I'll tell you this: I am definitely convinced that saying that by definition mutual funds or insurance companies are not systemically significant, that's a mistake.
Gentlemen, just to show you who actually runs the place, I'm the only member of Congress here, and I'm being told by staff on both sides that I have to stop now. And I will respect it because it comes from the Democrat staff as well. If it's these folks, I would ignore them. But I will close by saying this. Dr. Calabria, Mr. Silvers, the other gentleman, I'm sorry to get a chance to ask you gentlemen the same question because I'd be curious to know what your thoughts are. But Mr. Hill, Mr. Schweikert, and I have a bill that at least starts to try and begin a conversation about an alternative banking system, something that would operate outside of Dodd-Frank and be different for different types of banks, smaller, simpler banks. And don't be surprised if you get something from our offices in the next couple of days to ask you to weigh in on that, because we're very curious to know what a lot of folks think about it. So I appreciate your time. With that, we're going to recess for a few minutes. The second vote has not started yet. So my guess is as soon as the second vote starts, you'll see people starting to trickle back in. I cannot imagine we'll be in recess longer than 10 minutes. So if you gentlemen would like to take a break, now would be a really good time. And we'll stand in recess for approximately until, let's call it 2 o'clock. Thanks, gentlemen. Just immediately after votes. No, I'll just do it till 2 o'clock. That's fine. I know you guys wrote it down, but that's fine. That's okay.
Gentleman from Minnesota, Mr. Emmer.
Thank you, Mr. Chair, and thanks to the panel for your patience in being here. In the short time I have, there are just a couple of areas I want to cover which have been covered in some respects today, but I just want to make it clear because I have some things from my district that I want to share with you. Why don't we do, Mr. Zawicki, if you would, I think others have already given this testimony, but could you just confirm, do you believe that Dodd-Frank is actually harming the ability of financial institutions to make loans and offer credit to people and businesses?
Absolutely, yes.
And does this include minority-owned businesses?
Yes.
In fact, would you agree that Dodd-Frank is having a disproportionately negative impact on Americans of modest means and minority communities?
Absolutely, and we see that especially with the disappearance of free checking, which is upper middle class people, for instance, haven't really noticed that, but it's low income people who are the ones who can't afford these fees, who can't afford the higher minimum monthly balances to be able to get free checking. They're the ones who are losing it. It's also these same people who've lost access to credit cards over the past few years. It's the same people who can't get access to mortgages. Disproportionately, it's lower income people who are bearing the brunt of Dodd-Frank.
I'm going to quote, there's a couple of CEOs, the Goldman Sachs CEO has said, quote, "More intense regulatory and technology requirements have raised the barriers to entry higher than at any other time in modern history. This is an expensive business to be in if you don't have the market share in scale. Consider the numbers business exits that have businesses exits that have been announced by our peers as they reassess their competitive position and relative returns." And then J. Morgan Chase's CEO has referred to the post-crisis regulatory regime as creating a, quote, "bigger moat that protects his bank and other, quote, too big to fail firms from competition by new entrants and small firms that cannot internalize the costs of the Dodd-Frank regulatory requirements." Dr. Calabria, we've met, I apologize, I'm butchering the name. Do you agree with these CEOs?
Well, first of all, I think the evidence is pretty clear that concentration has increased, and I think this has always got to be a concern. So on one hand, regulation always bears a little heavier on smaller institutions, but I think it's also important to keep in mind a lot of these regulations are essentially intended to be barriers to entry, and so I do think we have to ask the question, are the institutions that are essentially kept out of the market the good or the bad players? So I do think that, and I guess I should emphasize too, as we know kind of from our Econ 101, you reduce competition, you're going to end up having higher prices for consumers.
Right, and basically what they're telling us is that the bigger guys are able to survive it. The smaller ones who are taking on these increased costs created by this extreme regulatory environment are suffering, and I'm going to give you a couple for the record. In my district, this is from a banker who will go anonymous. Quote, "We are a small community bank with 3 locations. Compliance has always been a cost. This is just a part of our business. However, since Dodd-Frank, this cost has expanded greatly. For example, within the last year, we had to hire a full-time compliance director at a cost of $60,000 plus benefits, and this is in addition to training 2 outside compliance firms. One assists our staff with deposit compliance and one with the loan compliance at an annual cost of about $40,000 per year. In addition to this, we have several members of our staff that their jobs have changed so that instead of spending time on revenue-generating activities, they are spending time on compliance. Unfortunately, since there is no offsetting revenue for this expanding cost, we are forced to consider passing costs on to our customers with additional fees. It's also changing the way they do business and the credit that they can offer to start-up businesses and consumers who are trying to buy their first home or buy an automobile. In my last couple of seconds, Dr. Calabria, again, the Office of Financial Research and Financial Stability Oversight Council are funded through assessments on bank holding companies. Effectively, this means that Congress has no appropriation mechanism to perform necessary oversight over these agencies. Do you think it would be wise for Congress to have more oversight of OFR and FSOC?
Absolutely. I'm of the opinion that every single federal agency out there should be in the appropriations process.
Anybody disagree? Mr.
Not at all. I agree with you 100%.
All right. I see my time's expired. I yield back, Mr. Chair.
The time of the gentleman has expired. Currently, there are no other members remaining in the queue. Thus, I'd like to thank our witnesses for their testimony today. Again, thank you for your patience to the schedule of floor votes today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask each of our witnesses to please respond as promptly as you are able. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. This hearing stands adjourned.